Good afternoon, guys.
Good afternoon, sir.
Shall we start?
Yes, sir.
Is my screen visible to you guys?
Yes, sir.
We'll just wait for like another 2 or 3 minutes and then we'll begin with the lecture. I see only like close to 20 participants there, that's all. Okay. Good afternoon once again to all of you. In today's session, we will be understanding the core concept of portfolio management. Before I talk a lot about, or before we dig deeper into portfolio management, I just want to quickly ask a simple question to you guys. That is correlating from yesterday's session. If I give you, like, let's say 10 lakh rupees today, how would you invest it? I would be looking for answers and seeking for answers. You can look at the slide and probably whatever comes to your mind. I want at least 5, 7 different answers from 7 different individuals. So I repeat the question, if I give you 10 lakh rupees today, how would you invest it?
Invest in gold.
Okay.
Sir, I have to check my risk appetite. Like, where do I invest in stocks or real estates or mutual funds? Which is my safer side?
Okay. I got only 2 responses. Others? Good morning, guys.
Gold, sir.
Gold.
The gold and mutual fund.
Gold and mutual funds.
Because
Okay.
the price of the gold is increasing day by day. Okay, so
Okay.
Invest in stocks.
You would invest in stocks. Two more answers if I have to get. Come on. Don't just overthink. Like, I just want your like gut instincts, I would say.
Sir, international investment, international exposure.
You would invest in international exposed stocks. Okay.
The cryptocurrency, Ethereum.
Okay, you would invest in Ethereum, that is your cryptocurrency. Great, right? Now, notice what just happened here within this online class, whatever we did. I just give you a small hint, if it would give you a 10 lakh rupees, so if you wanted to put it in stocks, why stocks? Because stocks will give you good growth. Some said gold for safety. Some said like cryptocurrency, like probably out of excitement or curiosity, I would say. And I heard real estates also for a little bit of peace of mind, right? What we did just now is we all just created the foundation of portfolio management. See, without even realizing. Why am I telling this? Because portfolio management is all about balancing risk and your returns. What is portfolio management? It is basically balancing your risk and your returns. So in order for me to align my, let's say my investment goals, right, I have to choose the right mix of assets. So probably we are supposed to think of this like preparing some sort of let's say preparing biryani, right? In order to prepare biryani, can I just dump in the rice and the meat?
No.
Will the biryani be ready?
No.
No, right?
No.
I cannot just dump in the rice or only the mix of spices or something like that, right? I need to have the right quantity, that is the right mix of the rice, the meat, and the other spices. Along with that, I need to have the technique, the cooking technique. Yes or no? And as a result, I will get a perfect outcome. Right? Similarly, in portfolio management, you need to have a diverse range of investments so that all of them, that is like, let's say, for example, your stocks, your bonds, your real estate, your gold, or even your cash, they act as a recipe, right? Mix all of these proportions, whatever is your risk appetite. By taking that, you will be able to fulfill your future goals. Okay. In today's session, you as a portfolio manager working in an investment banking division, you will not only understand what is portfolio management, but you will also understand what is a good portfolio management. How you could be working for a private equity investor or HNI client. You will understand the different types of investors that are there, what is their risk appetite, how you would act as a manager, that is a portfolio manager, in terms of managing the money of your clients, right? Be it a college student who is saving just out of pocket, you need to have a clear cut idea, where will I invest, for what is the returns, right? Like I gave you an example for a college student, right? If I am a college student, do you think that I will think a lot about my future?
No.
No, right? What if a person that is in his early career, who is married, he is going to think, right? He's going to think about his future. He's going to think about his kids, right? So every different set of life cycle of an individual, right? Right from like his birth up until his maturity, up to his death. All of the life stages of an individual, the 7 stages of life cycle, everybody has a different set of ideology in terms of investment and in terms of taking the risk, right? If I give you a bike and ask you to learn, that is if you are a teenager, that is 13, 14, 15, 16, if you are in this period of your life, you are not afraid of taking risk. You're not afraid of falling. You're not afraid or you're not ashamed of what if people might think that I'm learning. Now, if I ask you to learn a scooty or probably learn driving a four-wheeler, don't you think that you will be hesitant enough post you reach 22, 23? Yes or no? You might feel that ashamed. What if people might be watching at me? Yes or no? If you ever experienced that, that is basically this life stages of a person, right? You are ready to take more risk when you are a teenager, when you are independent, when you are single. But as and how your age evolves, as and how you grow, you will have additional responsibilities, and those responsibilities will make you think twice before investing. If you are investing, you would opt for safer investment opportunities. Are we clear? This is all about portfolio management that we are going to encounter in today's session. Are we clear?
Yes, sir.
Let us have an interactive session. Please, I need at least a response. I'm not asking you more than that.
हेलो 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 सर सॉरी सर
Yes.
यानी मेरी ऑडियो नहीं आ रही थी आज लाइक आई एम नॉट एबल टू कनेक्ट ऑडियो
Oh, audio या
आई एम
video?
नॉट एबल टू लिसन यू सो व्हाट आई मिस्ड कैन यू समराइज इन शॉर्ट
So basically, I was talking about what if I give you 10 lakh rupees, what would be your strategy in terms of investment? So couple of you said stocks, couple of you said gold, cryptocurrency, real estate, and I just made them realize that a combination of all of these investment is nothing but portfolio. And how you manage it, that is what we are going to study in today's session.
Okay, sir. Thank you.
Now, all of you understood the concept of portfolio, right? Portfolio and in terms of management, not the actual meaning, but a nutshell of how portfolio management works. Okay. So before I talk about portfolio perspective in terms of having how to create and how to build one, when you hear the word portfolio, what comes to your mind?
Sir, a combination of asset class.
A different combination of a different asset class. Okay. In generic term, let's not correlate with finance. In general knowledge terms, then tell me, if I tell you
A basket of different type of things
a basket of,
combined together to create one thing. Like if we want to if we want to assemble a bike, then we need an engine, we need a body, we need a tire, we need a brake.
Mhm.
Everything combined together will form a bike. But
Okay,
everything separate is also having its own identity. Like a tire separately can be sold.
fair enough. Like now in for me, if you ask what is portfolio in general terms, I would say collection of art.
Yes, sir.
Yes or no? If I start collecting different types of coins or different types of paintings, after a period of time, like let's say after 10 years from now, those art what I've collected or those coins whatever I've collected, don't you think that it is going to have a like a higher value in the market compared to what I had purchased it like 10 years ago or something like that?
Yes, sir.
Right? And likewise, if I have to think from another perspective, you will also have a career portfolio, if I may have to say, right? You started off working as an intern, right? Then slowly and steadily moved on to level 1, level 2, level 3, and then associate to senior associate, manager to assistant manager, senior most manager, right? This is portfolio of things that you have done over a period of time, and as a result, you become an expert in that particular knowledge or in that particular domain. Yes or no? So portfolio
Yes,
is
sir.
nothing but collection of things wherein you collect. And if I have to look at from a holistic view, right, that is giving me more added advantage or more added value. So in finance, if I have to tell a portfolio is simply a collection of different types of asset class that are your investments. Okay. But remember, it is not just about holding multiple assets or having a different collection of different assets, right? It is about how or each of those assets that you have in your basket, right? Each other are complementing, how each other are complementing to each other. How is asset class, that is, let's say, for example, how are stocks complementing towards your bonds? How are bonds complementing to your mutual funds? How are mutual funds complementing to the asset class that is gold? Right? Each other should complement. If somebody else, like let's say, for example, if gold is rising, then by default, your stocks might be underperforming. If stocks are performing, then the bonds might be not giving you better returns. But depending on your appetite of risk, appetite of your returns, what is it that you want? When you have that clear-cut perspective in terms of what is it that you want from your investment, that is when your portfolio perspective steps in. In a nutshell, if I have to tell you, a portfolio is nothing but it is a basket of financial assets. So when I say financial assets, you might obviously think of stocks, your bonds, your mutual funds, your commodities, your derivatives, your any precious gold, precious metals, anything for that matter can be considered as a financial asset. Okay. So the main aim of having a portfolio, it is to diversify risk. Remember yesterday I gave you an example. If I give you 10
Yes, sir.
lakhs and ask you to invest in different companies, right? That is, I asked you to invest in 20 different companies. So if one company is not performing, there are 19 companies that are giving you better results. And that one company ka loss, whatever it is, they are recovered by those 19 different investments. We understood the concept under systematic and unsystematic risk, if I may have to recall.
Yes, sir. Yes.
Right? One bad investment will not wipe out your entire savings. The other 19 investments what you have made, they are going to complement or overshadow that one bad investment. That is the reason we have diversification. Wherever there is diversification, we have introduced ourselves or we have exposed ourselves to the concept of portfolio.
Sir, sorry to interrupt you, sir. Am I audible?
Yes, you are audible.
Yes, sir. Thank you.
Okay. Okay. All of you are clear with the meaning of portfolio?
Yes, sir.
Okay.
Yes, sir.
Now, let us understand what is the purpose of having, or what is the main objective. That is the second pointer. What is the main objective of having a portfolio? See, the central idea, if I have to talk about portfolio, it is basically like, think like of, let's say, for example, if you have ever taken or consulted a diet, nutritionist, and if ever at all you have ever been on a diet, right? And you're, let's say I am on diet. Would you think that I would only consume sugar products or sugar only the entire day, or just the proteins the entire day, along not having anything else on my diet?
No, sir.
No,
We
right?
need
I
a
will have
combination
a,
of
yes,
different
I will have a
vitamins.
mixture of everything. That is, I need to have carbs, I need to have my proteins, I need to have a little bit of sugar. Sugar is, again, when I say sugar, it is not the actual sugar that we eat, but any sugar related products. A combination of all of this will create a balance on my diet. Can I survive 365 days a year just eating green leaves and green vegetables?
No, sir.
It's highly impossible, right? Like, there are people that are practicing, but for common man like you and me, it becomes difficult. We need to have a combination, right? Sometimes even those people, they have a cheat day. They cheat on whatever they're doing, like in terms of if they are not eating any sort of sugary product, at least once in a month they go out and have something related to sugar, right? To correlate that diet example with you with the portfolio, similarly in portfolio, what happens is that you need to have the mixture of your risky investments, your safety assets, in order to achieve the long-term stability. Say, for examples, if I have to put all of these financial terms in one sentence, I would say that, let's say, for example, I would invest in government bonds. What is the reason behind investment in government bonds? Reason behind that investment is safety.
Returns of
Risk free.
And safety. Then, if I want to have growth, if I have to multiply my investments, I would obviously look for equity. Yes or no? For safety, I have debt instruments. For growth, I have equity instruments. A combination of equity and debt, simply put together, will be considered as a diet, financial diet, I would say. Are we clear? Are we clear on the meaning of
Yes, sir.
portfolio and management?
Yes.
Can somebody help me understand what is portfolio management before I move on to the perspectives of portfolio management?
सर जैसे मतलब हर किसी की अलग वैल्यू है, जैसे लक्की ने कहा कि हर किसी की आइडेंटिटी होती है, जैसे पार्ट्स अलग सोल्ड होते हैं, तो वैसे ही सर हर बिजनेस की अलग एक वैल्यू होती है। और एक इंडिविजुअल की अगर 5 बिजनेसेस है और मतलब हर कई जगह पे उसने इन्वेस्ट कर रखा है, तो उसका मिला के जितना उसका पोर्टफोलियो हो रहा है उसको हम कहते हैं पोर्टफोलियो सर, एज आई अंडरस्टूड दैट।
Correct. And I hope all of you have understood the concept and have a clarity on what portfolio management is. Now let us understand the three different perspectives. That is two major perspectives and something related to those perspectives. That is risk return trade-off. We call as RRT. Now let us understand what is this individual perspective. See, for me, I am an individual. Yes or no? You guys are individuals. For individuals, our main goal is to preserve our wealth and grow it over a period of time. As a result, we, out of that particular growth, we tend to focus on meeting our, let's say, personal goals. Like, let's say, for example, I have a goal of by 30-35, I will need to have let's say, a house property of my own. Or by 40 years, I need to retire and enjoy my like retirement benefit plans or something like that. Right? For youngest investors like you and me, our main motive or our main criteria of investment would rather rely in equity heavy portfolios in terms of growing it or doubling it over a period of time. Likewise, if I have to counter whatever I said, it is basically to contradict my statement. For my parents, that is who are 45-50 years of age, for them, they are looking for investments that are stable. They would rather invest in gold or they would rather invest in a house property so that they have stability of income at the time of their retirement. So from an individual perspective, I look at investment from a different angle. Like, or similarly, my parents will look at a investment perspective from a different angle. For me, I am okay to take risk. For my parents, they are not okay to take risk. Even 100 rupees matter to them a lot. Am I creating a difference between wealth creation and wealth generation?
So wealth creation and generation.
Yes. So I am looking for wealth creation. They've already generated. My parents have already generated.
Okay, okay.
They are looking only for a stability in terms of retirement. When they are retiring, they need to have a minimalistic income so that they can survive without depending on their children. Yes or no? So as a
Yes,
reason,
sir.
what are they going to receive at the retirement age? They are receiving something called as pension. Yes or no?
Yes,
They
sir.
have a property that is giving them a nominal returns on their income, on their investments, right? They would rather invest in an FD rather than going for equity investments. Do they have that perspective, or do they think that, nahi, I need to invest in equity stocks so that I can gain more returns at that particular age, 45 or 50, 55 pe?
No, sir.
They do not want to risk even a single penny. Yes or no?
Yes,
So
sir.
from individual perspectives, we are okay. We want to grow our wealth, and likewise, we want to preserve our wealth. Slowly, steadily, we want to grow it in order to fulfill our future goals. Got it? Now, from institutions' perspective, the portfolio has a different angle. See, when I say institutions are like your insurance companies, your pension funds, or
Mutual
let's say, for
funds.
example, mutual funds. These are your financial institutions. From their perspective, managing money, it is not only for themselves, but for others. Okay. What is that obligation that these portfolio companies meet? They meet the obligations for the pension funds. So by investing in different asset class, like somebody, let's say, for example, who is of 60 years of age, his pension funds are safe. They must ensure that the retirees, whoever is going to retire after 60 years of age, he is going to get the money post his retirement. Insurance company, their main objective is to grow the wealth so that tomorrow, if somebody has an uncertainty or a disability, if they opt for a claim, their settlement is settled. Are we clear? From their perspective, what is their investment criteria? Their investment criteria is to grow the wealth to meet somebody else's obligations. Whose obligations? It's basically me and yours. It's mine and yours. What is my obligation? Let's say, for example, I am in a medical emergency. I need money. I have insurance policy. So the moment I opt for a claim, right, the insurance company has to settle that claim, right? That is their obligation. They are liable to settle it. Am I differentiating between individual and institutional perspective?
Yes, sir.
Both do the investments. Individuals also do the investments. Institutionals also do the investments. Individual, I do not have any obligation. When I say obligation, it is not mandatory for me to do the investment. I can survive without investments. If I do, it is for my personal benefit or my personal growth. If I start investing now, let's say after 10 years, from that value, I could buy a car or I could buy something that is of my own use. But for institutions, they have collected the money from the public so that they give them at the time of their retirement or at the time of uncertainties when the client arises. So they have to meet the client's obligation. So to meet that client's obligation, these institutional investors, they tend to invest in, let's say, for example, government securities. So that are stable and that will give them better returns. As a result, at time of need, they are ready to satisfy or they are ready to fulfill the demands of their clients. Are we clear? So how will I get my pensions after I retire? So a portion of my salary is getting deducted. Yes or no? That is getting deducted through the National Pension Scheme. Likewise, a portion of my salary is getting dividend for public provident fund. right? After I retire, the same money what is getting deducted every month from my salary, post my retirement, that I have an option of getting that all at once, that is lump sum, or I can have it over a period of time up until my death. That money, whatever is being kept in your PF account or your pension account, that money is not idle. That money is used by the institutional investors to invest in government aided projects so that they have the stability of returns, and they have the obligation to meet your obligations in the future. Are we clear on two different perspectives of portfolio?
Yes, sir.
All of you?
Yes, sir.
Okay, fair enough. Now look at the third perspective, that is risk-return trade-off. See, every portfolio decision that you and I take will have and will be associated with risk as well as returns. So I've been constantly telling, wherever you see there is high risk, what is the promise that the risk gives you? Higher returns, right? Whenever
sir.
you are having a
Yes, sir.
higher risk investment, the returns on that investments are higher, but it is always associated with greater uncertainty. Got it? When the risk is low, what about your returns?
Low return.
Low returns.
No.
Higher the risk, higher the returns. Lower the risk, lower the returns. Say, for example, if I am willing to invest in a tech startup or a startup that is working on artificial intelligence. So don't you think that if I invest there, I will have a promise that is made by the founders that they are going to give me huge returns? Yes or no? But it also, that investment also comes with the possibility of failure. What if that startup does not succeed? What if there are unheard roadblocks to that startup? My entire investment is gone, right? So the risk of earning higher potential always is associated with uncertainty of failure or possibility of failure. To counter or contradict my statement, what if I invest the same amount of money in government bonds?
Sir, the returns will be low and you will play in safer side.
You are
Yes.
promised guaranteed returns, but those returns are comparatively lesser to any other investments. This is risk return trade-off. So here, what are we trying to understand? Whatever the type of my investment is, what is it that I have the risk? So no matter what the investment is, what is the risk associated to that investment? That concept is called as trade-off, risk return trade-off. Higher the risk, higher the returns. Lower the risk, lower the returns. So the balance between these two is called as RRT, that is risk return trade-off. Okay. Now look at the fourth pointer. Portfolio approach is more effective than evaluating assets in isolation. So basically here I will answer the question why this particular portfolio approach matters to individuals. Okay. So let's say, for example, evaluating different types of assets. See, depending on their class or depending on their nature. Do you think that it is going to give me a different persona or different perspective? Yes or no? Like, if I evaluate assets one by one, depending on their nature, depending on their class, don't you think that it is giving me a different perspective from each other?
Yes, sir.
Yes,
But they're
sir.
not giving me a holistic perspective, holistic view. Yes or no? Say, to better relate that, if I know what is asset class stock, what do I conclude by stating that? If I invest in equity stocks, I have higher risk, higher returns. If I invest in debt, what is the nature of debt? Lower risk,
Sir,
lower return.
depreciate.
Lower risk, lower return.
Mutual funds,
Medium risk,
constant
medium
returns, medium
returns.
risk, and they will give you constant and medium returns. If I invest in gold, I know I have to wait for a longer period of time to better enjoy or double my profits. If I invest in real estate, I know that I have to invest and wait for at least 10 years for whatever my investment is to grow. Each of the asset, whatever I told now, they are unique in themselves and they are giving their own nature. They are giving their own perspective. they're not giving a holistic view or a full picture. I'm not able to capture the full picture. So portfolio perspective or portfolio management, it teaches me that why these different individual assets matter when I combine all of them together and form one portfolio. A different individual assets can behave differently, right? Yes or no? If I look at them from in a basket, if I have a basket and I have different set of investments, from that perspective, if I look at, if one is rising, other might be falling, and the other might be rising, the third one might be giving you steady returns. If I combine all of this, it is striking a balance between my stability, that is my growth. Are we clear? So
Yes,
that
sir.
is why you as a manager, whenever you are borrowing the money, whenever you are taking public's money, you tend to invest that in different set of asset class so that it strikes the balance. Got it? Rather than you going and betting just on one asset. Cryptocurrencies will give you good returns, right? Yes or no? Your crypto investments or your Forex investments, they are also going to give you better, good returns. But what is the possibility that your capital is safe? Not even 50%, right?
Yes, sir.
Strong move and your entire capital is wiped out. What if you have 10% of your capital invested in Forex or cryptocurrency, 20% invested in equity, 30% invested in debt, the remaining 50% invest in different set of asset classes? Don't you think you are going to become a successful investor?
Yes, sir.
Yes, sir.
You are definitely going to become a successful manager to manage the different types of asset class. As a result, you are not going to just bet on one particular asset. So in order to sum it up everything, whatever I explained in this particular slide, I would simply put portfolio is all about your own perspective. Whether you are an individual investor planning for, let's say, your retirement, or when you're dealing for somebody else's money, that is when you are an institutional investor, you are there managing billions of dollars of rupees. Why? To meet their financial obligations. In either case, in individual case or in an institutional case, the ideology or the idea behind the investment is same. What is the idea behind investments? To strike the balance between risk and return. Are we clear?
Yes.
All of you?
Yes, sir.
Okay. Now let us understand the steps in portfolio creation or portfolio management. Okay. So managing portfolio is a one-time decision. Sorry. Managing portfolio is not one-time decision. It is a continuous process and evolving process. Right? Just imagine like when you are constructing your house, constructing a building. You just construct like that, or after construction, you tend to manage that or maintain that.
We have to maintain it.
You will have to maintain it, right? I cannot just build a building and just let it go like that, right? In order to build that particular building, I need to have a step or I need to have a plan of action. I first need to plan the design, then choose the right quality of the materials. Then I will start building. Yes or no? Post building, I will also have to assign myself the responsibility that I am going to repair that whenever there is a sort of leakage or whatever the damage that the building might incur over a period of time. So basically, I will also promise to repair it and improve the quality and efficiency of that building over a period of time. So similarly, like how I give you an example of having a building constructed, post construction, you will also maintain it. We will understand that from portfolio management perspective as well. Okay. So the first step in portfolio management or construction is that you are supposed to set investment objectives. So this is one of the first and very important step that you are supposed to determine and define what your investor wants. It could be, let's say, for example, your investor would want to grow. When I say grow, it is basically your investor would want to build the wealth over a period of time. Okay. Now, the second objective, it could be whatever I mentioned there, income. Your second objective could be income, your client's objective. He wants a regular or steady income. So what does income mean? He wants to generate regular cash flow. Right?
Yes, sir.
And some other client might want to invest because of safety. He wants to preserve his capital. Simply put, let's say, for example, a 25-year-old, he might want to invest in aggressive stocks, or he will invest aggressively in order for long-term growth, to build wealth quickly. Yes or no?
sir.
He wants quick money, quick exits, quick entries. While
Yes, sir.
a person who is in his early 50s or late 60s, he would obviously look at the investment as a part of preserving or safeguarding his capital. He wants safety. Along with safety, he is looking for stable income. Okay. So now this particular investment objective, it is clearing the air, or it is giving a clear-cut idea or clear-cut picture. What is it that you want from long term? See, either you are a youngster, or you are a mid-aged person, or you are in your early retirement stage. In either of these, all of us want income. At the end of the day, our investment goal is for income only. Yes or no? But the question arises, how you want to build that income, or how you want to have that income. Whether you want to invest aggressively or you want a stable income. Are we clear on setting up of the investment objectives?
Yes, sir.
Okay. All of you,
So,
you are supposed to define what here? Define an individual goals. As a portfolio manager, your main aim is to understand what is it that your client wants. Whether he is looking for growing his assets, whether he is looking for a stable income post his retirement, or whether he is looking for preserving his capital, safeguarding his capital. That is your first step. Step 2 is assessing risk tolerance. Excuse me. Assessing risk tolerance is the second step. Next, as a portfolio manager, your main role or your main responsibility would become to determine how much risk you or your investor can tolerate. When I say tolerate, it is basically how much he has the capability to bear. So risk tolerance, I would say it depends on your age, that is your client's age, the client's income stability, your client's financial responsibilities, and their personality. Say, for example, me and Sahil, both of us are friends. Both are earning same sort of salary. Both are working in same company. Both are of similar age. What did I just say? Both of us are of same age, same company, we're drawing same salary. Okay.
Yes, sir.
Both of us have stable income. Let's say I have more commitments, more financial responsibilities than Lucky, or than Sahil, whoever was there. I am so sorry. Whoever comes first, I'm taking their name. Let's say me and Lucky.
Yes.
Understand the context? I have more financial responsibilities compared to my friend. So what do you think here my perspective would be? Perspective A, scenario A I'm giving here. Scenario A is that, will I be likely to take, both of us are investing, imagine that, okay? Will I be likely to take high risky investments, that is by investing in equity, or I would look for some better returns, that is basically having returns basis on, like, let's say 6% or 7% nominal returns. Which one would I opt for? Scenario A or scenario B?
B.
Scenario B. Why? Because my financial responsibilities back at my place are more compared to my friend Lucky. And Lucky, Lucky, whatever he is drawing, let's say for example, out of that salary, he is just spending 10% on his personal use and rest 90% he's saving because he does not have any financial responsibility, nor is he spending on his parents, nor his siblings, anything for that matter. As a result, he is ready and he is okay to take the risk and afford investing in rather than looking for stable returns. Are we clear?
Yes, sir.
I do not have the willingness to take risk. Even if I want to, my responsibilities will not let me take that risk. But Lucky, he has the entire willingness to take. He has no strings attached for the investments to be made. Now, all of you understood the concept of risk tolerance between two persons?
Yes, sir.
Okay. Another example I would give you to correlate the same set of ideology. That is, let's say, for example, there are two friends, me and Anuj. Both are of 30 years of age. Anuj is working in government job with stable income. Okay. And I am a freelancer. Do you think I will have a stable income? I will
No.
have irregular income. If I get
No,
the
sir.
client, that is when I make the money. If I don't get the client, I will not make the money. Anuj, can he afford taking the risk? That is higher risk in the market.
Yes, sir.
Yes.
What would I prefer? I would prefer having a safe investment.
Yes, sir.
So even though we are of the same age, but having different sort of income streams, our risk tolerance differs. In first situation, when I consider myself with Lucky's example, there also we were of same age. But because of the financial constraints, we could not invest. Our risk tolerance was different. It is not only with regards to age, it is regards to what is your income potential,
Income.
how you are making money. You need to understand, you need to ask these questions to your clients. Whenever you're handling portfolios, right? You need to ask a question like, what is the source of income that you are having? On that basis, you are going to plan the risk tolerance capability, or you are going to design the assets where and which one would be best for them. All of you understood the first and the second step?
Yes, sir.
Yes, sir.
Moving on to the third step, that is asset allocation. This is one of the most important factors, or I would say one of the most important drivers of portfolio returns. So once you identify the goals, you know what is your goal, what is your client's goal, you know what is the risk-taking capacity or appetite for them. It is now you are the one who is going to decide on how much and where to allocate. When I say where, basically it is which type of asset to allocate the funds in. So where will I allocate equity? Why will I
Stock.
allocate equity?
For a
For
person who
better
is looking
return.
for
For a person who is
Better
looking
return.
for growth, definitely yes. When would I allocate funds in debt?
for stable income.
For stable income. Then when would I allocate different alternatives apart from debt and equity? Like let's say, for example, real estate, commodity, or derivatives.
So when I want to hedge my
Let's start
position,
with real estate. I was too quick. Real estate, if
when
I
I'm looking for long-term investment,
long-term investment. For commodities,
commodity.
they are not risky, but they'll give me good returns.
Sir,
Yes.
real estate.
Sorry?
Sir, real estate.
For long-term,
Sir, gold.
long-term growth.
Stocks.
Commodities,
Mutual
short-term growth
funds.
with high risk.
Mutual funds.
Yes, mutual funds, derivatives, right? Now different asset classes are there. Okay. Now, so to give you the example, you will create a balance for your investor, that is basically for your client, and you might choose 60% of his investment in equity, 30% of his equity, 30% of his allocation of his funds in debt, and 10% in gold. Remember, while I was in the first slide of the session, I told you that biryani cannot be cooked by dumping all the ingredients or by dumping in the rice and the meat. Yes or no? So similarly, asset allocation is not just like cooking. You need to decide on the ingredients before you cook on that perfect set of dish, whatever you're planning to cook? Yes or no? If I have too much of salt, will you be able to consume?
No.
No, sir.
If I add too much of sugar instead of salt, will you be able to digest that?
No.
No, sir.
No, sir.
No, right? So if
No.
I add too much of spice, that is your red chili powder,
No. No, sir.
too little of it, the taste
Yeah.
itself does not balance at all. I need to have the right set of measurements, and only then I will be able to come up with a beautiful dish. Likewise, in the investments also, whenever you're building a portfolio, you need to understand what is your client, what is his source of income, what is his financial responsibilities, how much risk he can take. Once you check all of these boxes, only then you are going to decide on how much should I invest out of the 100%, where will this 100% be diversified so that he is getting good returns without harming his future or without destroying his future. Are we clear?
Yes, sir.
Yes, sir.
Yes, sir.
Now, the step 4 is you are supposed to security selection. So after deciding on the asset classes, now it is time for us to select the actual securities. Now, let's say, for example, what is this security and what is this asset class? Understand? See, instead of me just saying investment in equity, I have to decide what type of equity I am going to invest in. Basically, now in equity investments also, I have too many companies listed in the stock market.
Yes, sir.
It is now the right time for me to decide whether I should invest in Infosys, I should invest in Reliance Industries, or I should invest in Just Dial. Which type of equity investment I am going to go? Equity is the asset class. Security is the type of share of that particular company. So which one would I prefer? Infosys, Reliance Industries, or Just Dial?
Reliance.
Not able to classify? So see, if the investor is looking for good returns, he does not want to take too much risk while investing in equity. So that type of investor ke liye, I would recommend investing in Infosys or in Reliance Industries.
Yes, sir.
Right? Because their fundamentals, their technicals, both are strong. But if my client is looking for equity investments, but the condition that he has given me or that I have understood after talking to him is that he is okay to take the risk. So in that case, I will look for good returns that will give me huge returns just by investing in that particular share. But that shares or that equity security is highly volatile. Right? Let's say, for example, equity assets equity investments like your investment in your Indigo Airlines or Just Dial, they are highly volatile. They give you quicker returns and as well as they are very risky. So what is it that you're doing here in security selection? You are deciding on what is the type of actual security you will be investing in when you decide on the class of the asset. So instead of just deciding or saying equity, you're deciding whether it is Infosys or Reliance Industries, whether it is Infosys or Just Dial. Likewise, instead of just saying debt instrument, I have to pick or I have to categorize that investment, whether it will be government bonds or it will be corporate bonds. Now, am I able to clarify better?
Yes, sir.
Yes, sir.
Right? Now, instead of just saying gold, whether I will invest in physical gold or whether I will buy a gold sovereign bond, whether I will invest in real estate or real estate investment trusts, REITs.
Yes,
Okay.
sir.
So this is where, or this is when we tend to do a lot of research, build the valuation, and analyze what each of these security is going to play a role in your investments. For me to talk or to explain this, it is hardly taking 5-6 minutes. But when you're actually working on the piece of paper, right, you will have months together of research done. The security selection. Equity, mein how many asset classes, how many assets are there in equity? How many companies are traded publicly?
More than 8,000.
Yes or no? More than 50,000, I would say. Now, out of those 50,000, how are you going to filter out? How are you going to decide which is going to give? It's going to consume a lot of time, right? For me to just to talk, I took like close to 5-6 minutes to explain one point. Imagine if you are working on a real client building profiles. It's going to consume a lot of your time, but you have doing the research only one time. You know what is it that returns are giving? So you can recommend that product to a different set of clients. Yes or no?
Yes, sir.
Yes, sir.
Next, let us understand the fifth step. What does the fifth step say? Can somebody read it out loud for me? Step 5. Fifth pointer. It is
Portfolio construction.
portfolio.
construction.
Here, what we do is we combine all the selected assets, their types of securities that we have opted for, into one single portfolio. Here, my main aim as a portfolio manager is to create the mix of all that works together. So basically, I am here diversifying across the industries. Now, if I have to talk about industries, let's say, for example, in equity investments also, I have different set of industries that I can invest in. I have banking sector, I have ceramic sector, metal sector, automobile sector. Yes or no? Don't you think that it is giving a lot of permutations and combinations?
Yes, sir.
Right? Now, also, I will have to think from geographical perspective as well. Whether I will invest in the products or the companies that are based out of India or based out of a foreign nation. Yes or no? I cannot simply tell that I want to invest in a tech company so that I will just invest in one or the other tech companies that I see. I cannot do that, right? I cannot invest all in equity tech or equity FMCG. Yes or no? I will have to include some assets, some securities from tech sector, some from the banking sector, some from the pharma sector, some from the FMCG sector. Along with that, I will have to include SBI ka corporate bond or government ka sovereign bond. Or I will also have to consider aluminium, tin. A combination of all of this is construction of portfolio. Are we clear here?
Yes, sir.
Now, the next step, that is sixth step, is monitoring and review. Like I said, after building the building, you're not just letting it go. The moment you go every month to collect the rent from your building, out of those tenants, you also happen to look at what is the condition of the building. Yes or no? If the lift is operating properly, if the swimming pool is maintained properly, if there is any sewage problem, any leakage problem, whether the painting has to be redone. All of these things you check, right?
Sir, we can say that we are going to inspecting whether the portfolio is giving return or not.
Fair enough, right? Similarly, your portfolio is never static, right? You have to monitor it regularly. You have to check for the market conditions. You have to check for the internal and external factors. How is the market performing? Based on the performance of the market, how is your portfolio reacting? What is the economic policy that has come out? How is that going to affect your debt instruments? Right? And also, I will have to look at the internal factors of the client. Is the client happy with the returns what he's getting? What is his personal situation? Right? Is he still generating income? Is he still employed? Is he unemployed? All of this should be constantly checked, constantly monitored, and constantly reviewed. Let's say for example, if the equity market has a boom, when I say boom, it is rise. And your portfolio becomes, let's say, for example, 80% returns on your investments. You were expecting 60% returns, but market is giving you 80%. What will you do? Will you book your profits there, or will you wait? I was assuming 60%. Now the market is giving 80%. Let me wait for another 20% so that I have 100% return on my investment. Will you do that? Or will you book at 80%?
Book at
I will
80%.
book at
80%, sir.
You will
Minimum
take at
80%.
80%, you will book all your
Yeah.
profits there, and you will
Yes.
let go of your investment. That is your principal investment. Let it be like that.
Yes, sir.
Reviewing. Consider another example. It is the market is rising, but your debt market, that your debt investment is not giving you good returns. The economic policy is against the investment. So in that case, will you keep on holding on to that debt investments and say, "Nahi, I will wait for another 5 years, another 2 years. I know bond market will rise." That is foolishness. When the market is indicating and signaling you, it is the right time for you to rebalance or to shift from one asset class to another asset class. So wherever you are getting the profits, you book the profits. Wherever you are getting the loss, you try to balance it with the profits that you have earned. Okay. So if my equity asset class has given me 80% returns, it is time for me, if I do not want to book the profits and take it home, it is time for me for that 20%, whatever additional I have incurred, right? 20 or 40%, that should be rebalanced, or that should be shifted to some other gaining asset class. Like let's say, for example, gold. Let's say, for example, real estate. That is going to be there. That is going to give me positive returns only. But in the long run, are we clear on terms of monitoring and review? How am I supposed to monitor and how am I supposed to review?
Yes, sir.
I am not confusing you, right?
No, sir.
No, sir.
Finally, the seventh step, if I have to talk, it is evaluation and revision. What are we going to do here? Here we are going to check, did my client's portfolio meet the original objectives? Remember, you had designed the objectives in the first phase or the first step. Step 1, what is it that you determined? You determined the client's goals and their objectives. So step 7 is you are going to evaluate. You're going to cross-check. Did the portfolio, whatever I created, meet the objective of my client? If yes, you're good. You're well and good. If not, what are you going to do? You are going to revise. You're going to change. And you're going to analyze what is it that went wrong. Say, for example, my primary objective was to plan for a child's education. For in the next 10 years, I want one of the kids or one of my siblings to study abroad. That was my main goal. After 10 years, when I'm evaluating my objective, I will look at the portfolio. Okay? It is the portfolio that is basically my strategy. Does that strategy need revision? Yes or no? If it is yes, then you have to think of shifting it from the different types of asset class, different types of approaches that you have in your investments. Are we clear on all the 7 steps?
Yes, sir.
So in a nutshell, if I have to summarize all of the 7 steps, it is not just buying the stocks randomly. It is about having a systematic approach, systematically defining what is the goal, what is the income that my client is having, what is the amount of risk he is liable to take. And then at deciding on allocating these assets, or whatever assets you have, allocating it wisely, selecting it carefully, and then building it strategically. Allocating wisely, selecting carefully, and building strategically. And lastly, you're going to monitor continuously. Along with monitor, what are you going to do? You're going to revise it. Are we clear?
Yes, sir.
Yes, sir.
Next slide is all about types of investors and their distinctive characteristics. Now that we have understood what is the meaning of portfolio, what is the meaning of portfolio management, and what is the steps that come under portfolio management process. Let us now try and understand or focus on who is that person exactly. Who are these investors? Okay. See, after all, if I have to say, your portfolio strategies will vary depending on what is the type of the investor that you have and what are their different characteristics that they belong to. The first type is individual investors. Who are these individual investors? Avik, mute yourself.
Oh, sorry.
Who are these individual investors? These are
Sir,
individual investors like you and me. Yes or no? These are everyday people like you and me. What are our personal goals? Our personal goals are to save, to invest. It could be saving for retirement. It could be buying a car, buying a house, planning an international trip, planning for children education abroad. All of us are individual investors. Our goals are clear, but individual investors like you and me are always exposed or usually have limited capital compared to the other types of investors. That is your institutional investors. Yes or no? No matter whatever my salary is, will I be able to compete along with LIC? Compete with the
No.
mutual fund company?
no, sir.
No, right? So
No.
it is my decision that is going to have an influence on my choice, on my risk-taking appetite. It is my knowledge on the finance. It is my behavior, or it is my behavioral tactics. Whether I am confident enough, whether I am not confident in that investment. All of these combined together is one called as individual investors. Are we clear? Yes or no?
Yes.
What are the characteristics of individual investors? Tell me.
So they have their personal goals.
They have their
With them.
personal goals, yes.
And
Their
they're looking
capital is
for the
limited.
safe investments.
They look for safety in investments. They always want to accumulate and grow wealth. Yes or no? And they always want to have something called as personal savings. These are a couple of characteristics of individual investors. Are we clear?
Sir, securing their future, we can say that is a characteristic.
Sorry, once again.
Securing their future.
Basically, the ones who are looking to secure their future is called as an individual investor. Now comes your institutional investors. So institutional investors, it's unlike your individuals. Institutional investors are large scale organizations. Like, can you give me an example?
LIC.
Pension funds, LIC, mutual funds, insurance companies. So they are the
Yes.
ones who are managing or who manage billions of dollars because their size, because of their size, they are able to enjoy the economies of scale. When I say economies of scale, it is basically how much ever they have the investment, they can invest in different asset classes. As a result, they gain access to excessive instruments. They have a dedicated research team of their own. They have a dedicated resources of their own. They trade in those type of asset class that is going to create a significant impact in the equity markets or in the debt markets because of the volumes that they trade in, because of the volumes that they invest in. Are we clear?
Yes,
They
sir.
have access to everything that they want. They need capital, yes, they have it. You need returns, better returns, greater returns, yes, they will do it for you. These are your institutional investors. Can you think of an example and give me an example of an institutional investor, one in India and one globally?
SBI Mutual Fund is an
SBI
institutional
Mutual
investor.
Fund from India. Okay. One global company that you can think of?
BlackRock.
BlackRock. Yes. Now, the third type of investors are your retail investors. See, retail investors are often confused with your with your individual investors. There is one difference between your retail and your individual investors. Okay, so the difference is that the retail investors, they tend to typically invest in small amounts through brokers or through online platforms. How are you going to differentiate between individual and retail investors? Now tell me, we fall in the category of retail investors or we fall in the category of individual investors?
The retail investor.
We fall in the category of retail investors. So that is why, if you recall, I did not give any example for individual investors. So individual investor, let's say I become an individual investor the moment I start investing from the first job that I secured in my life. Only in that case, I become an individual investor. Okay. So a retail investor is basically the one who invests in very small portion of amounts through a intermediary, that is your broker, or through a online or through any online platforms, I would say. So don't you think that as a retail investor, I will have limited access to investing in sophisticated investment opportunities? Can I diversify my portfolio? There are constraints for diversification as well. So if I combine a portion of, like, if I combine all of the retail investors, we make up a large portion of trading activity. Am I clear now?
Yes, sir.
All of you, for the three types of investors, your individual, institutional, and retail investors. Are we clear with the first three types?
Yes, sir.
Yes, sir.
Fourth type of investors are your HNIs, high net worth individuals. So high net worth individuals are basically those people or those individuals who are having a large surplus amount of funds to invest. They are the ones who are having financial strength, or financially they are strong. They have an access to, say, let's say, for example, to invest more in alternative investments, not just in the equity and in the debt. So they are basically the ones who act as your angel investors, who act as your venture capital firms, who act as a hedge fund. So anyone that falls in the criteria or who has surplus amount to invest, they become high net worth individual. Are we clear? So you are the
Yes.
ones who will be, like, as an investment banker, you are the one who will be majorly dealing with these type of investors. Who are they? HNIs, high net worth individuals. They are the ones who often are looking, or who are the one who want to invest in the companies or in the portfolios that are risky, but that gives them higher risk. Okay. They always rely on wealth managers, portfolio managers, who can professionally manage their wealth. This is where you step in with. This is where you guys step in to manage their wealth. They are appointing investment bankers. It is also called as private bankers. Are we clear? Yes or no?
Yes, sir.
And lastly, you have foreign investors or global investors. Foreign investors are also called as FIIs and FDIs. FIIs are foreign institutional investors. FDIs are your foreign direct investments. So these are the investors who are typically outside of your country. They are the ones who bring in the capital flow into your country. FDI, it is for your long-term commitment in the business. It's basically for the government aided projects or a private aided projects that are going to run for longer period of time. Research division of that particular company, R&D department of that particular company. These companies are usually funded by the foreign bodies. And foreign institutional investors, FIIs, they are the ones who are looking for short-term gains, or they are the ones who are short-term market participants. They invest in stocks, they invest in bonds, and they are the ones who bring in the liquidity, stability from a global perspective. Okay. Suddenly, if you see the markets rising or falling, it is because of these guys. Suddenly they pump in the money and dump in the money so that there is a sudden volatility in the market. Quickly, what are the 5 types of investors that we have encountered in the session?
Individual, institutions, retail, HNIs, and foreign.
If you are clear,
Yes, sir.
we will take break, and then possibly after the break, it's 2:23. By 2:35, we will be back and continue with the DB and DCs. And then we will take 5 minutes break. We will be here during that break, but I want you to think and then answer. I will explain when we take the second break.
Okay, sir.
Okay.
Sir, can you repeat? Actually, your voice was not coming properly.
So I was telling, let's take break till 3:35. After that, I will cover 2 subtopics, and then we are having a activity that you are going to design on a portfolio. We will work on that. Before we start working on that activity, we will take 5 minutes break so that you can think of a plan and then talk. I hope all of you
Okay,
got
sir.
in the group.
Yes, yes.
Yes,
Thank
sir.
you.
Yes, sir.
Okay, fair enough. We'll meet at 3:35. Yes, whoever it is.
सर अविक है सर
Yes,
मैं
sir.
बोल रहा हूँ कि सर मेरी मतलब माइक अच्छे से आवाज आ रही है सर आपको
हाँ.
ओके सर ठीक है सर कोई नहीं
चलो मिलते हैं 15 मिनट
हाँ हाँ
Hello guys, welcome back. Now, next we will understand the defined pension plan versus the defined contribution plan. See, first and foremost, whenever you are dealing with the high net worth individual, right, the major aspects that you will be working for will be the DPS and DCP. DPP and DCP. So from that perspective, I am giving you a context of what these DPP and DCP refer to. So to help you understand, let's say for example, you are in your early 60s, or let's say you are 60 years old and you are about to retire. So, and let's say you have worked for almost 35 years. Okay. Now, after 60 years, who is going to ensure that you have money every month credited to your account after your retirement? Huh? You want me to repeat the question?
Yes, sir. Please.
Who is going to ensure that you have, like, let's say, enough money to survive every month after your retirement? You're not dependent on anyone.
The pension organization.
The pension organization, okay.
My retirement plan.
Your retirement plan. So basically, you are trying to say that either your employer, he is going to guarantee you a fixed income no matter what. That is through the pension. And second possibility that you're telling is that your income depends, like, or basically on how much you and your employer, like, saved it over a period of time. That is through your retirement benefit plans and how the market has performed over those 35 years. So what we just discussed is one is your defined in pension plan, and the one is a contribution plan or defined contribution plan. So defined pension plan, if I have to explain you, defined pension plan is a guaranteed returns on your investments. So what are these guaranteed returns on your investments?
Sir, FDs.
No, from retirement perspective.
The PF.
Provident fund, okay. Your pension.
PGT, pension.
PF and your pension. See, because both of them are your benefits that are given to you by your employer. Yes or no? No matter what, provident fund is deducted from your salary. No matter what, if you are opted for pension scheme, that is also deducted from your salary. Okay. Now your provident fund or your pension, let's consider the pension because pension is what you deal with a lot. So your pension is calculated as a percentage of your salary, the basic pay, that is multiplied with, let's say, for example, the total years of experience that you have. That is multiplied again with the last drawn salary. The basic pay multiplied with total number of years of service multiplied with your final salary or the last drawn salary. If you calculate this, you are liable to generate pension. That is the value of your pension that you will be getting from your employer. Okay. Are we clear? Now,
Yes,
this,
sir.
whatever value you have, you divide that with 12 months in a year, you are liable to get that much value per month. Are we clear?
Yes, sir.
All of you? If not, see, I will, the formula is percentage of basic pay into years of service multiplied with the last drawn salary. Okay. Now, let's say you have a percentage of your basic pay is 2%. 2% multiplied with, let's say, I give you an example of 35 years old. Right? How many years of experience you might have? 30 years of experience. So 2% into 30 and your last round salary at the time of retirement was 1 lakh rupees. So 1 lakh into 30 into 2 by 100, if you do, you will get how much?
60,000.
60,000 per month is your pension amount up until you die. Are we clear? This is your pension. And it is applicable to all those employees in India, those who were working for the state or the central governments or any government agencies before 2004. After 2004, it is not by the employer, it is by the employee on his own. If he wants to, he can enroll for the pension scheme.
Sir, can you repeat the calculation part?
The formula,
Yes, sir. Yes, sir.
percentage of basic pay multiplied with number of years of service into last drawn salary. Okay, clear all of you with the pension concept? Are we clear on the pension concept?
Yes, sir.
Yes, sir.
So the last pointer under pension concept, employer bears investment and longevity risk. Who bears the risk here?
Employer.
Employer. Employer bears the investment risk, employer bears the longevity risk, either of the cases. See, if market crash, the employer still has to pay you pension. Yes or no?
Yes.
If you live for 95 years or 105 years, the employer still has to pay you. No matter what your age is, you are supposed to get the pension. That is longevity risk. Longevity risk. And investment risk, if anything bad happens in the market, that is basically when the market crashed, your employer still has to pay you the pension, no matter what. Okay?
Sir,
In
I have one
contrast-
question.
Yes.
Sir, my grandfather get pension at the age of 77. Right now, he also get pension. Sir, my question is that he ended service in the firm he used to work. Sir, sir, अभी भी उनको सर pension कैसे मिल रहा है?
That is what I told you. Any employee that was working with the government or government agent jobs before 2004 are all liable to receive pension up until their death. And if they have their dependents, that is direct, immediate wife, spouse, that is spouse and immediate children who are not independent enough. Till they come to of an age of 2021, the government takes the responsibility to allot them pension, to give them pension every month.
तो वो सर कंपनी नहीं देती, वो गवर्नमेंट देती है.
Government, ha.
Okay. Thank
So
you.
earlier there were a lot of government jobs only, right? So the government was the employer. Got it?
Yes, sir, I got it.
Now, we will talk about defined contribution plan. So defined contribution plan, in contrast, what does it say? It is not going to promise you the fixed benefit. There is no guaranteed benefit here. What is happening here? It is basically you and your employer both are contributing to your retirement account. And that particular contribution is invested in the markets. Okay? So at the time of your retirement, whatever investment you had in your account, that is completely yours. Say for example, suppose your provident fund contribution is 5,000 per month. And let's say your employer is also contributing 5,000 per month. So that is how much of investment every month that is being made?
10,000.
10,000 every month. Let's say you work for different companies and this is your policy that 5,000 from your employee side, 5,000 from your employer side. Over a period of 30 years, the amount of funds is accumulated, right? Yes or no? So over 30 years, let's say on an average, you are getting 8% returns annually. So that 5,000 what you started off has the potential of giving you retirement benefit plan close to 2.5 to 3 crores. Not 3 crores, 1.5 to 2.5 crores. I would not exaggerate there. Are we clear on that part? So this depends on the market's performance. If the market rises, your potential investment will also rise. If the market falls, your investment will also decline. Here, both of us are sharing the risk. Who are the both of us that are sharing the risk? Both the employee,
Employee and employer.
employer. What type of risk? That is, it is your money that is at risk. Employee's money is at risk. So the more return, the more risk is on the employee's shoulder rather than on the employer's shoulder. Got it? And don't you think that in this case we do have longevity risk? What if you die on before you enjoy the retirement benefit? What if you die in the early 37 or 40 years? It is a problematic situation, right?
तो those who work मतलब फैमिली में जो वर्क नहीं कर रहे हैं
Sorry?
सर वो फिर फंड आप बोल रहे हो ना फिर वो फंड ट्रांसफर हो जाएगा उनके वाइफ या तो उनके चिल्ड्रन
But
पे
you are
जो
not
भी वर्क
enjoying benefit, no, is what I'm telling. Yes or no?
Yes, sir.
You are not enjoying the benefits here. Are we clear on the DPP and DCP? Next main concept is asset management unit or asset management industry. Okay, how does this work? Buy side and sell side. What are these sell side and buy side? We will understand that from this slide onwards. So let's say you are working or you are residing in one of the financial hubs in Mumbai. And in the streets of Mumbai, there is a street called as Dalal Street. You know Dalal Street?
In Mumbai, sir.
Yes.
And there you see a lot of investment bankers. They are logging out late in the night. Yes or no? The streets are always crowded. That particular street is always crowded. They are the ones who are preparing the pitch books for their corporate clients. Okay. On the other hand, on the other contrary, let's say, for example, you move across the street, you find a lot of corporate companies. There you find fund managers. So what is their role of the fund manager? It is to review the portfolios, mutual funds, whether to decide on buying or selling the stocks tomorrow. Both of them, like I said, the investment banker that are working late in the night and the ones who are deciding on buying and selling the stocks tomorrow, both of them belong to asset management industry. But the way they operate is different. One is on the sell side and the other one is on the buy side. Okay, that is what I'm going to explain you and help you understand that what is the distinction between the sell side and buy side. How are they representing both in one organization or in one industry? And why are they so much essential in investment banking? So in a nutshell, do you guys know what is asset management ecosystem or AMU, asset management companies?
Bought some.
Sorry?
Not much. Not much. I don't know much about them. I know them, but I don't know much about them.
So asset management ecosystem is basically a company that manages the entire in and out of the financials, representing buy side clients as well as the sell side clients. So this particular ecosystem is divided into two halves. One is the sell side, the other one is the buy side. So in sell side, what happens is that they are the ones who create and sell the products. They are the ones who research and who offer services. This is the sell side. In buy side, what is happening is that they are the ones who use those products that are created by the sell side people. They are the ones who use the products in order to make the investment decisions. See, in simple terms, if I have to tell you, imagine an investment bank representing both sell side and buy side. In sell side, what are they trying to do is that they are acting as a supply of capital markets, supply in capital markets by helping companies or clients raise capital through the market. Got it? In buy side, what is happening is that in buy side of investment banking or AMUs, it is the demand or the demand side of the capital markets. In simple terms, you understood? Sell side mein, they supply in the capital markets. In buy side, they are the ones who are demanding for capital markets. Both go hand in hand. One is the creator of the product. The other one is the one who makes who makes those products as an investment tool. If you want to raise the capital, you will raise it from selling the shares of the company to the general public. That is the sell side. Got it? In buy side, if there is demand in the market, only then you will buy the shares of the company.
Yes, sir.
Now understood? Sell side, it talks about the supply in the capital markets. Buy side, it talks about the demand in the capital markets. Sell side, they are creating the product. In buy side, they are using the products created by the sell side to act as an investment decision.
सो सर इसका मतलब ये है कि हम लोग जो आईपीओ मतलब जो कंपनी आईपीओ ला रही है मार्केट में तो वो सेल कर रही है अपना स्टॉक्स को
हाँ
राइट ओके और हम लोग जो वो लोग हैं जो बाय कर रहे हैं उसको
हाँ
buy
Now think, see, I will give you an analogy to better correlate. Think of it like a restaurant. In the sell side, it is the chef who prepares the dish.
right
Yes or
sir.
no? And it is the restaurant who markets that dish. Yes. In buy side, it is me, the customer, who chooses what to eat.
Correct, sir,
The
correct.
different products in the restaurant's menu, right? I decide on what to eat depending on my taste preference or on my eating appetite. Are we clear? Yes or no? Unless and until a restaurant does not have a good chef, does not sell the product prepared by that particular chef, will you think that they will be able to sell something in the market? No, right? So in the sell side, it is the chef that they have and the restaurant as a marketplace. On the buy side, you have the customer who chooses what to eat out of the menu based on his risk appetite or preference. Are we clear? What is this asset management ecosystem? All of you, are we clear on this? It is a combination of both asset side, that is sell side and buy side. Now let us understand the concept of sell side in detail. Pay as much as attention, ask as much as questions you want to. I will first try and explain my point of view and then you can shoot out questions on me. One of the important concepts in investment banking, sell side and buy side. A lot of confusion and a lot of questions can be framed out of either side, sell side and buy side of IB. Shall we begin?
Yes, sir.
How many participants are there? 26. Okay, fair enough. So the sell side, this includes institutions that are basically creating, promoting and selling the securities, or they are the ones who are providing the services. Example, let's say for example, you have your investment banks, that is your Goldman Sachs, your JP Morgan or your Morgan Stanley. And they could also be your brokerage firms like Zerodha, Grow, ICICI Securities, etc. And they also have key players that are among the research division or research firms. Who are the ones? Like they are the ones who are publishing the equity research reports. Okay. The main function of this particular sell side is to issue securities or issuing of securities. How do you think that issuing of securities happen? They are the ones who are helping the companies to go public by raising the capital through an IPO or a bond market. And they are the ones who are going to provide them with a detailed research analysis. They are the ones in the sell side, they are the ones who tend to analyze and publish the stocks that are acting as a recommendation to either buy, sell, or hold. And also in the sell side, they are the ones who are facilitating what trades to happen. They are the ones who are connecting the brokers, buyers, and sellers. Brokers are trying to connect the buyers with the sellers. Okay. Say for example, when Zomato went public, right? Who are the ones who helped them? It is the sell side of the investment bank. Okay. The sell side of the investment bank, they are the ones who structured the entire IPO. They were the ones who priced the shares. They are the ones who created a road show, who created a pitch deck, who pitched it in front of the investors, and they discovered the price. And they are the ones who sold them first to the institutional investors and then to the retail investors. The entire IPO process is from the sell side of an investment banking. And what about their equity research division or the team? They are the ones who tend to design or who tend to focus on the research analyst part. Okay, they are the ones who came up, let's say for example, we are expecting Zomato to grow by 25% with a target of 120, 125 over a period of 3 months. So if they are not there to promote this, not make a statement in public like this, do you think that there will be demand in the market for Zomato share? Example? It won't be, right? So the overall, in nutshell, if I have to say, they are the ones who are selling the products, helping companies to launch their IPOs. Got it? Got it, all of you?
Yes, sir. Yes, sir. Yes, sir.
Yes,
Now,
sir.
how do the sell side of investment banking or asset management companies, they make the money? So the sell side makes the money by earning something called as professional fees and commission. They charge professional fees of XYZ lakhs, XYZ crores, and they charge a percentage, 2.5 to 12%, something between that. They charge commission on the IPO, anything that they do. Got it? The main objective or the main motivation for the sell side of the IB firm is to sell a transaction. And they are not the ones who are guaranteeing you the returns of profits. They might act as underwriters, but they are not acting as a guarantors. Do you think investment banker will be held accountable if the IPO does not succeed? No, right?
But sir, the underwriter will be.
That is why they appoint underwriters. For underwriting, they also charge commission. Look at the business model. That is what I'm explaining. For underwriting, they charge commission. They are charged fees. In either way, the investment bankers make the money. Are we clear? Yes or no?
Yes, sir.
Yes, sir.
So if you see, have you ever seen an investment banker coming in news or making headlines?
No, sir.
99% of the time, you do not see any investment banker making the headlines. That is in the negative aspects. Why? Because they want to maintain good relationship with the companies that they cover. No matter which company that they are covering, they will maintain a healthy and a good relationship. If anything happens, they act as an external auditor, they act as a research analyst. They will tell that we already had warned them. Remember the case of Byju's when EY was questioned about their acting as an external auditor. Why were the issues not flagged? Why were the filings felt so due in the long run? EY told that we resigned from the post of external auditors long back, and we reminded Ravindran Baiju that the things that he is doing are not in the favor. That's all. They got a clean sheet. Now, have they destroyed their relationship with any other companies? EY? No. They're positioned well in the market. Are we clear on the sell side perspective, all of you? Yes or no? I am taking that as a no, and then moving on to the next slide. That is the buy side. So in buy side, it is the other way around. Whatever is happening in the sell side, it is correlated to your buy side. So here in buy side, it basically refers that you buy a security with the main purpose of investment and managing the money on the client's behalf. Example, on the buy side, you can find key players like your the mutual fund companies. There are HDFC, AMC, SBI mutual funds, HDFC, AMC. These can be considered as a key players here. And if I have to talk about the hedge fund companies here, I would bring in Geojit Finance, I would bring in Bridgewater Associates and Renaissance Technologies. They are the ones who are in the buy side. And for pension fund, I could say Employee Provident Fund Organization. Got it? And also we could also bring in Abu Dhabi Investment Authority. Are we
Yes.
clear? They are the ones who are representing the buy side. What are they doing? They buy the
They are
security for investment purpose by managing the money on the client's behalf. So don't you think that the moment you deposit your money in HDFC AMC, in your mutual fund, don't you think that HDFC AMC is going to invest your money in the markets to earn benefits on your behalf?
Yes, sir.
Yes.
So that is basically buy side representation. So how are they managing portfolios? They are managing portfolios by investing in equities, by investing in debt, by investing in commodities, foreign exchange, or any other alternative investments. Are they not generating returns?
They are,
They are.
sir.
They are generating returns. They
Yes,
want to
sir.
generate returns. The primary goal is to beat the traditional investments, the traditional benchmarks. Whatever return Nifty 50 has given you over 1 year, they make sure that usse zyada these guys are giving you the returns. How? By managing and diversifying your portfolio. They strike a balance between what is the risk, what is the return, and what is the trade-off that is between your risk and your return. Got it? A company like HDFC Mutual Funds or HDFC AMC, they are the ones who use the money that is deposited by the people of the country. Like say lakhs and lakhs of people are depositing money in the mutual funds. All the Indian investors. And as HDFC AMC, I am the one who is going to invest in the IPO as an institutional investor. Or I am the one who is acting as an institutional investor that is investing in Infosys derivatives, Reliance Industries ka derivatives. Got it? Another example, if I have to give you, Hindenburg is a hedge fund company, right? Hedge fund company. They are always preparing the equity research reports, publishing it no matter which part of the country they are in. Right? Yes or no? If they tell you that they are planning or they might think the possibility of shorting Tesla or short sell Tesla, and they are hoping the battery operated companies to fall, that means that the moment the report is out, there is fear in the market. There is panic in the market and people start
Yes, sir.
selling.
Yes, sir.
It happens because of these hedge fund managers. And if they tell that they are looking on a positive hint, they might think that the Boring company is going to impact on Tesla's operations. And as a result, Tesla is going to have a boom in the market. In that case, everybody don't want to miss out on the opportunity. They will start buying the stock the moment the news is out. Who's putting these research reports? It is the buy side of the hedge funds that are influencing people to either invest or divest their property. I mean, divest their investments.
So, so the both of sell and buy, both sides recommend something.
Both, yes, they go hand in hand. See, Goldman Sachs has buy side as well as sell side. JP Morgan has buy side as well as sell side. Sell side will not interfere in the operations of buy side will not interfere into the operations of sell side. And if I am, let's say for example, EY, I am the one who is launching the IPO for, or I am the one who is planning a merger and acquisition for, let's say, a small company, right? I will not be, it is against the ethical practices to be the buyer of the company that is on the other hand. I cannot represent two companies at once who are direct competitors to each other. If I am managing your books from buy side perspective, I am ethically stopped that I will not be representing the sell side from their perspective. So that is why when an IPO happens, if at all you read the first page of the IPO, there is lead managers, book runners. There's not only one company or one investment banker. There are 3-4 different investment bankers. One is representing the buy side, the other one is representing the sell side. You look at the advertisements of IPO, that time you will understand and correlate the concept. Are we clear?
But sir,
Mm.
like when they recommend a stock, sell side,
Okay.
if they are recommending a stock or like they issue stock recommendation, they get benefit from that research also,
Yes,
or they get benefit from the company.
they get benefit from both. In the buy side, their main revenue model is to make money through management fees. So what they do is that they charge 1 to 2% of AUM. What does this AUM stands for?
Asset under management.
Asset under management. Whatever assets that they have under their management, they charge 1 to 2% fees on that. And sometimes they also charge something called as performance fees. If the investment outperforms the research, in that case, you will have to give them the performance fees. So here their main objective in terms of earning the money is to make more money.
So this is for buy side.
This is for buy side.
Like buy side get profit by AUM and stock performance.
Yes.
So they will have a particular client. Like for example, I am a buy side investment banker. I represent Zomato. So I am legally I am not ethically I am not obliged to represent Swiggy.
No, not like that. Not like that. You are not obliged to be on the sell side of the same company. Zomato.
Of Zomato.
Yes. You can be the buy side or sell side for any other company. That is not a factor. See,
But sir, Swiggy is direct competitor of Zomato, no?
so what? You think that Swiggy has appointed Deloitte and Zomato has not appointed Deloitte? Their operational teams are completely different. The person who is representing the buy side or the sell side of Swiggy will have no direct contact with anybody that is working for a project or working with the client Zomato. It's highly scrutinized. So the reason that this scrutiny is that there is no conflict of interest between, or there is no leakage of information between the departments. You think it is easy to represent the buy side or the sell side of the competition in the company? It's not possible at all.
Okay, I can represent sell side of both Swiggy and Zomato, but I cannot represent sell side and buy side of a same company.
Yes.
Okay, and in sell side, I will be earning by the fees.
In sell side, you are basically producing the ideas or the product, or you are giving the research tips. In buy side, whatever you're suggesting, right? You are making it happen. You are making decision.
I'm asking the revenue. Like in sell side, my revenue is from fees and commission.
Yes.
I will be having a fixed fees as
Yes.
a representative of a sell side.
Yes.
Um,
In side, you are charging fees. There is no commission. Either you are charging management fees or you are charging performance fees.
like AUM fees and performance fees.
Yes. Are we clear?
Okay, so sell side fees will be decided on the basis of like AUM fees will be like if I am managing 100 crores and I am charging 1%, then it will be one crore.
Yes.
But it is of buy side.
It is a buy
But
side.
how will be decided in sell side? Like in sell side, what will be my fees?
Commission.
Commission of what?
Successful IPO.
Okay, like I will be getting the fees from the person who is selling the shares. Like if in Zomato, Dipinder Goyal is selling his shares, then I am getting a fees from Dipinder Goyal or Zomato.
Yes.
Okay.
Sir, suppose if the IPO gets undersubscribed,
Hmm.
so in that case also, I mean, the company who wants to, raise its capital, they have to pay the fees to this one.
They have to pay the fees, upfront fees they will have to pay, yes.
Okay, sir.
And second thing is that if the shares are unsubscribed, they act as underwriters also.
Underwriters.
For
Yeah, underwriters.
underwriting, they charge commission.
Yes.
Yeah.
Sir, the underwriter and the sell side can be different companies, no?
Yeah. I can be, see, if I am helping them as a lead manager or the lead book manager, I can act as an underwriter also. Or if I do not want to participate, I can appoint somebody who will act as an underwriter. Okay. So basically, the two sides are like, basically, it is like a coin. You toss a coin, you have heads and tails. Both are the faces of the same coin. So basically, in sell side, what is happening from an investment banking perspective is that they are the ones who produce the ideas or the products, or they are the ones who give you the research insights, and they are the ones who makes the market liquid. So in buy side, it is whatever the sell side is doing, they counter that by selling it. Matlab, they make the decision happen. If buy side is launching an IPO, sell side of the investment banking, they are the ones who are recommending you to buy that, to invest in that IPO. They are the ones who are influencing your decision making process. So basically, let's say, for example, if I am representing a sell side of an IB company, so I am entitled with working in research division. So we will publish a research report or a research report through a brokerage firm, and we tell people to recommend Infosys with a target price of, let's say, 1,800 to 1,850. Okay. Now the buy side, what are they doing? Buy side, basically, they are the ones who are managing the funds of, let's say, institutional investors. You are acting as a fund manager there. I might read that is my company, that is the sell side is representing a target price of 1,800. Ultimately, I will decide whether to invest the funds in Infosys or not. Are we clear? Yes or no?
If I invest in Infosys, then how are they going to get profit from that recommendation?
They are building volumes in the market, no?
So, matlab, like they will be already having a position in that stock.
Obviously, I will create liquidity in the market, right? See, revenue model pay, don't dig deeper. First, understand the concept of buy side and sell side. How are they operation? First, operations part is important.
Okay.
Revenue model for both is earning commission. That is the primary source. Uske alawa, they don't look at anything. Do you think they will prepare a free report for Infosys and publish it in the market? Are they
No,
so
sir.
ruthless?
No, sir.
Then who will tell them to prepare the report? Who will tell companies to prepare the report? Is it out of curiosity that the investment bankers will go, नहीं नहीं यार चलो आज Infosys का report research करते हैं उसके बारे में publish करते हैं? It is HNI clients who demand the reports. They want to know where their investments are there. They want to know how will the investment perform if they invest in Infosys, if they invest in Reliance. They cannot study on their own. They will appoint investment bankers. They will do their research. They will analyze the reports. Then they will recommend whether to buy or not to buy. And you are the ones who are making the decision. Are we clear now? Let us not focus more on the revenue model, but rather focus on understanding the buy and the sell perspective, buy side and the sell side of the IBs.
Okay.
Remember the revenue model, one thing is that they earn commission. Whatever they do, they are earning fees or commission. Are we clear?
Yes, sir.
So in the sell side, what am I recommending? I'm recommending to buy Infosys shares with a target price of 1,850. So in the buy side, as a mutual fund manager, I will read that and I am the one who is the decision maker here. I will decide whether to buy or not to buy. That's all. Got it? So during an IPO in sell side, what happens is that in sell side bankers, what they do is that they are the ones who issue the market. When I say issue the market, it is basically they are the ones who tell the price and this is the market issue that we are going to do. But in the buy side, they are the ones who are going to decide on how much of those issues should be subscribed. Am I making sense now? So remember the IPO process.
Yes, sir.
What happens in an IPO process? Tell me what happens in an IPO process.
Like there is an investment banker who will advise them, who act as underwriter.
All 7 steps, please walk me through. The first step is appointment of investment bankers. Okay, next.
Red book hearing.
Sorry.
Due diligence and draft prospect.
Okay, then the investment bankers conducts a due diligence, then file a DHRP with SEBI, then
Marketing roadshow.
Then where will price discovery go?
Sir, after roadshow.
After roadshow, price discovery. Then book building.
After price discovery, book building.
Then
IPO launch. No, then allotment, then IPO
Allotment
launch.
and listing.
during this entire IPO process, right? What is the sell side part of the investment banker doing? They are marketing on the issue. Yes or no? They are the ones deciding
Roadshow and marketing.
what? No, not the marketing part. They are the ones who are deciding how much the company should dilute their share capital in order to raise the capital.
Yes, sir.
Got it? But the sell side, they are the ones who are deciding if the company is launching a 4,500 crore IPO, how much as an investor, that is an institutional investor, we have to subscribe. Sole trading and proprietaryship is also the part of investment banking, right?
Yes, sir.
Yes or no? In that sole trading and proprietary trading, there is a concept of they themselves investing in the companies.
Yes, sir.
Right? Now, do you think that if the shares of the company or the said company, if they are not subscribed, what is the buy side going to do? They are going to act as an underwriter. Are we clear now?
Yes, sir. Okay.
So to help you better correlate this, basically think of this buy side and sell side as a pharmaceutical company. What does pharmaceutical company do? They manufacture drugs, right?
Yes, sir.
They write a research reports as well on those drugs.
Yes, sir.
That is post-studying, they do that. And in the buy side, who are the ones who are going to prescribe the medicine to the patients? Is it the pharma company?
Doctors.
Doctors,
Doctors.
yes or no?
Yes, sir. Yes, sir.
Yes,
Now,
sir.
are you guys able to understand? Buy sell side mein, if they are selling the products, buy side mein, their representatives, your mutual fund companies, your institutional investors, they are recommending, they're acting as a bridge to recommend you the products. Got it? Yes or no?
Yes, sir.
Sir,
Yes.
sir, basically, in asset management industry, buy side analyzes the research report of sell side and then recommend the products to the client.
Buy side are the ones who make the decision of doing what the sell side is suggested. Sell side is the one who are structuring your products, who are advising you. Buy side, you are taking the decision based on the advice. Now I advise you, Akshat, please, from tomorrow onwards, I want you to do build 5 research reports or read at least 5 research papers. That is my advice. To act on that advice, it is your call, right? It is your decision whether you want to read 5 research papers or not. It is left to you. The choice is yours. Yes or no?
Yes, sir. Yes, sir.
Say another example I will give you for representing an asset management or connecting the asset management with IB. Let's say your corporate client wants you to hedge your currency risk. The investment in currency is also a risky part, right? Your client is
Yes, sir.
asking you to hedge that particular position. Okay. The sell side of the banker, they are the ones who structure the currency swap as a contract. Sell side may, if there is no swap contract created, do you think in buy side that hedging position can be created?
No, sir.
It cannot be created, right? Yes or no?
Yes, sir.
Okay. So in a nutshell, to sum it up, both the buy side and the sell side, to wrap it up, both the aspects, sell side, they are the ones who create, who promote and sells. Are we clear? In buy side, they are the ones who buy, who invest and who manage. Both the parts, that is sell side and buy side, they need each other. That is why I said they go hand in hand. Without sell side, there shall not be any supply for the products. And without having the buy side, there will not be any demand in the market for that product. Okay. Usually the sell side is having high pressure to work with. On the buy side, you are not having that much pressure. So if I ask you which career path would you choose, would you prefer buy side or the sell side? Sell side, always remember, it is always working on a hot seat. On the buy side, you are just managing what is happening, basically managing the portfolios, generating the returns, things like that. Are we clear on the buy side and sell side of AMUs in IB?
Yes, sir.
Next is investment policy statement, IPS. So investment policy statement is one of, again, the important aspects when we are dealing in the investment banking, basically in the portfolio management division. Okay. So let's say you are a doctor, though you're not a doctor or you won't never become a doctor. Let's imagine that you're a doctor. So before a doctor prescribes medicines, right? Before I am a doctor and I have to prescribe the medicine. Before that, I need to understand like my patient's full history, his current health condition. Yes or no?
Yes, sir.
Unless and until I do not know what is the underlying cause or underlying disease, I will not be able to prescribe him the medicine.
Yes,
Right?
sir.
Similarly, in finance, before we make any sort of investment decisions, we need to understand the structure. And that structured document, it is called as investment policy statements. What is an IPS? It's basically a blueprint for investing. What does the blueprint do? It clearly outlines what has to be done, what is expected out of this, and what is the outcome of this. Yes or
Yes,
no?
sir.
You can write it somewhere. An IPS is a blueprint for investments which is a written document.
Sir, can you please repeat again?
An IPS is a blueprint for investments which is a written document, which is a written agreement, not document, which is a written agreement that clearly outlines the client's investment goals, strategies, and can you somebody can read out that, please?
IPS is a blueprint for investment, which is written agreement that clearly outline the client investment goals, strategies,
And risk tolerance. So you guys understood, right? An IPS is nothing but a structured document or a written document that has three things that are mentioned. That is the goals, the strategies. Goals are basically the goals that you are supposed to achieve. And to achieve those goals, what is the strategy that you have? And to achieve those goals, what are the possibilities of incurring the risk? These three things are important, and that document is called as IPS, Investment Policy Statement. Okay? Are we clear? This IPS statement has three major roles or three main roles. First one is it provides clarity. So it, like, let's say, for example, if I have a clarity of I want to retire and I want to become rich. This is just my wish, right? Yes or no?
Yes, sir.
This is a wish or a vague goal, I would say. In order to convert this vague goal into a measurable objective, I include a quantitative aspect. That is, let's say, for example, I will write it down or I will restructure my writing. I need 2 crores by 2025 or by 2035. Got it? I need 2 crores by 2035 with moderate to less risk. Now, is the goal of retiring early, retiring rich, is it measurable in terms of years and in terms of number?
Yes, sir.
Yes, right? Then that is providing me the clarity. And this clarity can be found on the IPS, Investment Policy Statement. The second main objective or the second main role of the document is it should be discipline. It needs to have discipline. So for an investor like me or anybody, investor or a mutual fund manager or portfolio manager, I will have to refrain myself from making emotional decisions or decisions that might arrive due to panic, due to anxiety. Okay, that means whatever strategy that I had written it down, I should follow it diligently. Got it? Yes or
Yes,
no?
sir.
Yes,
Yes,
sir.
sir.
Say for example, in 2020 COVID crash, all the portfolio managers, they acted very diligently and quickly, right? Yes or no?
Yes.
Everybody, like
Yes,
the
sir.
retail investors like you and me, we started selling our investments as early as possible. But the investment portfolio statement, the IPS statements, who had a clear-cut objective, they sold, they reduced their investments to half. And the moment the market started seeing support, that is when they started dumping in the money more. They avoided rash selling, they started investing heavily. As a result, over a period of 3 years, they received more than 100% returns. Are we clear? This can be
Yes,
achieved
sir.
only if you are disciplined. And the third one is having consistency.
अमन फोड़ी की रबा तू तो खुद फोड़ ले ले रहा है
Pratham, can you mute yourself? Consistency is the third main goal. So basically, consistency, it acts as a long-term reference point, I would say. What is this reference point?
So from where
I'm
I
consistent and I promised myself that no matter what, every month I'm going to deposit this much amount of money in my investments. Do you think that that is going to impact if the portfolio manager changes?
no, sir.
No,
Sure,
sir. No, sir.
my policy or my statement will ensure that the strategy continues over the period of time. Are we clear?
Yes, sir.
Let us take like 20 seconds ka break. And have you guys understood the concept of the investment policy statement?
Yes, sir.
Now look at the fourth pointer. Who uses it? Institutional investors, pension funds, endowments, and individual investors. See, IPS is not only for individuals, but it is also for the institutional investors. Okay. Say, for example, if I've talk about this IPS statement, it is basically used majorly by all of the institutional investors. Okay. Say, for example, Harvard's endowment fund. Have you heard of Harvard's endowment fund? No?
So it provides fund for the research.
So Harvard's endowment funds is one of the largest endowment fund plans in the world, I would say. So
Yes, sir.
it is managed based on the detailed IPS structure. So what is it ensuring? It is ensuring investments that aligns with the long-term goals. Like let's say, for example, research funding or providing scholarships to students. So in a nutshell, if I have to tell, IPS is the one that is acting as a bridge between the client's goals, that is your client's goals, and their investment strategy. So without you guys, without your portfolio managers or without the asset managers, that becomes a guesswork. Okay, all of you are clear? So any investment that is aligned with discipline and that could be measured will be considered as to be as a worthy investment, or it is a guess investment or guesswork. It's basically gambling. Are we clear?
Yes, sir.
So there are 5 key components under investment policy statement. What is required when you are preparing an IPS? What are the things that you have to take into consideration? First one is that you need to understand the client's profile. We always have to start off with understanding the client's profile. So this will include your client's personal details like his age, his family status, his marital status, his future goals, what are his real needs, what are his perceived needs, and what is his expectation in terms of returns, and what is his investment experience. Say, for example, I am having a client who is of 30 years of age, who is working in an IT firm or a software company, right? Who wants to grow his wealth over a period of next 25 years. Got it? Now, this is one client profile. On my other hand, my client is 65 years old, who is retired, who wants to have an independent financial life. He is looking for a stable income. Both the clients have different persona, different personality, right? So I will need to have a different set of strategy for a 30-year-old and a different strategic plan for a 65-year-old. Yes or no? They are completely different, and so will their IPS be different. So the investment policy statement for both of my clients will be different. Are we clear? Second one, we tend to observe their constraints. What are these constraints that we are talking about?
Risk-bearing capacity.
Their risk-bearing capacity, or what this is the section that defines like how is my client making money? What is his source of income? Do he have only one source, or there are any other passive source that he has? Got it? Now, on this basis, I am going to decide on what are his responsibilities. How much he has to give here, how much he has to give there. What is it that it is saving with him? And only after that, I will move on to his tolerance. That is the risk tolerance. Will he be able to take the risk? For a 65-year-old, can I suggest 15% risk, 20% risk? No, right? That will
No,
become
sir.
absurd. Yes or no?
Yes, sir.
So here, the willingness of taking the risk is completely psychological. You as a manager should strike the balance between that. Are we clear? Yes or no?
Yes, sir.
Next, you are supposed to asset allocation, or you are to come up with the asset allocation policy, which is considered to be as the heart of IPS. Why is it considered to be heart of IPS? Because it is the one that defines how much to put in the equities, how much to put in the bonds, real estate investments, or any other alternative assets. How are you going to arrive at this conclusion? By understanding the previous aspects. Yes or no?
Yes, sir.
And then monitoring and review. What happens in monitoring and review?
So checking that
Checking
I'm
your
getting.
The
investments.
performance
As
of
and how your
assets.
investments you are checking, your life also is changing, right?
Yes, sir.
Your jobs will change. You will have more
Age.
responsibilities, right? You will have a marriage. You will have retirements, right? You might also encounter few global economic crises like how we had to deal with COVID. So that is when monitoring and review comes into picture. So all of these 5 pillars of your IPS statement, they work together in designing the plan logically, aligning with the goals, and adapting to the changes. So think of an IPS like a GPS. We always tell this in the finance that think of IPS like GPS for investments. What does GPS tell you about? You can
Where to
easily
reach
track
and how to reach.
how to reach, what are the roadblocks, what is the traffic, how long will you take to arrive at the destination. If what happens if you take an alternative route, is the time increased, the time decreased? Similarly, your investment policy statements also deal with the same structure, but here monetarily. Are we clear?
Yes, sir.
Next is, yesterday we were covering on the aspects, like yesterday what did we study in yesterday's session?
Types of risk.
We studied types of risks. What are the 4 types of risks that we studied yesterday?
Market risk, credit
Market
risk,
risk,
liquidity
credit
risk.
risk,
Credit risk,
liquidity
liquidity risk,
risk,
and operational risk.
option risk.
Operational risk. Systematic risk and unsystematic risk. In simple words, if I put it. Right? And how do I control the risk? Is what we are understanding in this session. It's correlated to both the types of risk as well as types of risk associated in managing the portfolios. That is why yesterday's class I stopped before this subtopic. So in risk mitigation, when every one of us are here, we take risks every day. Yes or no? Whether be it crossing of the road, lending money to my friend, or keeping money in my savings bank account, depositing it with a jeweler. In finance, the risk is not, it isn't avoidable at all. Risk is always associated with your investment. It is basically like an oxygen in the air. But when there is risk associated with the investment, we ourselves have to ask a question. Are we prepared? Are we prepared enough to bear the risk? Taking you back 5 years ago during COVID-19, what happened? The businesses shut down. That is overnight shutting down of the businesses, I would call it. The markets were falling like crazy nomads. Investors, the companies, or even the smallest of small ordinary families, everyone were suddenly exposed to the risky environment that we have never seen in our lives. Yes or no? In this, during this particular period or during this epidemic, what happened? Most of them collapsed. Some of them collapsed, not most of them. Some of them collapsed, while people like you and me, we survived. Because we were lucky enough and we took some precautionary measures, I would put it that way. Yes or no? I am talking about the risk that was associated to our lives, that is death. Had we not taken those precautionary measures, what would have happened? We were not sitting here and discussing risk mitigation strategies. Yes or no?
Hello.
True or false?
True, sir.
True, sir.
Huh? Right? So what we did at that time was we mitigated the risk. We diverted our risk. Okay? To mitigate and divert the risk in finance, we have 3 main techniques or 3 main strategies: hedging, diversification, and insurance. We will talk about it one by one in detail. Hedging, remember the example that I had given you about the airline company?
Yes, sir.
Yes,
What is the
Delta
biggest
Airways.
cost to the airline company? The price of crude oil. The cost of incurring or the cost of purchasing crude. If oil prices rise tomorrow, what will happen to your profits?
The decline.
The
Profits will
profits
decline.
will crash, basically decline. So what do? Can you control the rise and fall in the oil prices?
Yes, sir.
Can you control? You
No,
can't
sir.
control the
No,
rise
sir.
and
No, sir. No, sir. No,
supply and
sir.
demand of
We
oil.
can hedge. We can hedge.
You
We
need
can
to
hedge.
hedge.
Yes.
Like, it's basically the concept of hedging steps in here. It's like you are buying yourself an umbrella. Can you stop the rain?
No.
No.
No, sir.
But can you stop yourself from getting drenched in that rain?
Yeah.
Sir.
Yes.
Airlines, they tend to hedge the fuel prices by entering into what type of contract?
Forward.
What is that
Hedge
contract
contract.
called as?
Hedge contract.
Forward
Derivatives,
derivative. Sorry.
futures, options, forward or swaps. Can you always rely on one type of contract? Forwards. Can you
No.
always say that?
No.
It is a type of
No, sir.
derivatives contract, right? So I would use derivative, the right terminology here. So airline hedge themselves by entering into derivatives contract, that is either a futures, options, or a forward contract. What they do here, they lock in at today's price for months ahead. Are we clear now?
Yes, sir.
So how do exporters and importers hedge?
Based on the currency.
Based on the currency, right? Now, if I am an Indian farmer or an Indian IT firm, I will hedge my currency against US dollar. In what cases?
If
The
I will
US
hedge
prices.
dollar
hedge contract here.
declines.
Sorry.
If US dollar declines,
You are going to make profit or loss?
loss.
You are going to incur loss. In order to avoid that loss, you will enter into a currency swap contract. That is basically, it is acting as a safety wall for your transactions. See here, in hedging, it is not about making money, not about making profits. It is about not losing your money, your potential investments when the markets are against you. That is the main reason you enter into hedging as a contract. Are we clear on the hedging part?
Yes, sir.
Okay, before we move on to the diversification part, can you guys think of an everyday example, basically that you see in your life every day on day-to-day basis, right? Where you would like to lock in a price for today in order to avoid the future uncertainty. Which product would you lock in the price for? Any everyday example that you can think. Every day, whatever is happening in and around. Not
petrol.
related to.
Sir, in insurance,
Uh-huh.
sir, for future uncertainties, we should go for insurance, like life insurance, vehicle insurance.
Insurance is what you want to lock in. But insurance का price थोड़ी ना ऊपर जाएगा.
Sir, petrol.
Petrol.
Gold.
Gold.
Sir, food products.
That some mutual fund like
Sir,
Parak.
milk, sir.
Milk. Okay.
Sir, food products like rice, wheat.
Okay. Commodities basically.
Yes.
Okay. Or if
Real
you
estate, sir.
understand sorry?
Real estate.
Real estate properties, yes.
Paneer.
The treatment cost.
Treatment cost you would lock in. Okay. Anything that you have the fear, कल को उसका दाम दुगना हो जाएगा या चार
Sir,
गुना हो
gold,
जाएगा.
gold and silver.
Yes,
Sir,
that you
silver
can
का दाम
consider to be as hedge. If given an opportunity, I will lock in the gold price today. अगले 10 साल तक I don't want gold to go up.
For
After
me.
I buy, let it go wherever it wants.
Yes, sir.
Got it? That is hedging. Now we will talk about diversification. This is the second shield that is called as diversification. So there is a saying in general that is basically do not put all your eggs in one basket. Have you heard of that saying?
Yes.
Yes, sir.
Why is that there a saying on do not put all your eggs in one basket?
Because if one gets rotten, everything will be rotten.
Yes. If you carry all your eggs in one basket and you drop it, you lose out everything. But if you spread them across the baskets, even if one falls, there is the other one that is
Other
still
would be safe.
Recovering it.
recovery. Yes. In finance, diversification works the same way. So investors spread their money across different assets, under different securities. So even if the asset class crashes, that particular security will not crash. That creates a balance between the asset classes and securities themselves. What are these asset classes that I am talking about, and what are these securities that I am referring to? Tell me 5 asset classes. Krishna? Krishna, can you tell me 5 asset classes quickly? Anuj, yes.
Mutual fund, equities, real estate,
Funds,
gold,
equities,
currencies,
gold, currencies.
cryptocurrencies,
In equity,
cryptocurrency,
give me any 2 securities.
Reliance or Infosys,
In debt, give me any 2 securities.
So commodities too.
Securities. Commodities, maybe though. In debt, can I say SBI mutual?
SB
SBI corporate bond,
bonds, sir. Yeah,
gold sovereign
government
Yes.
bond.
bonds. Yes, sir.
In alternative investments, can I say REITs?
Yes, sir.
So these are different types of securities. Are we clear? What we did here? We as investors, we spread the money across different asset sectors, asset classes, and even if one of the asset class is not performing, the other are complementing them. Imagine if you had invested only in airline companies in the year 2019 and 2020, and you hated to invest in pharma sector. What happened in either of these sectors?
It was a huge boom in pharma sector.
There was a huge boom in pharma sectors, and the airline sector were falling left, right,
Declining.
center. And tech companies, they were on the verge of breakouts. Microsoft को पकड़ने के लिए, like we had to have at least 100 elephants tied. Tesla was growing, Microsoft was growing, Infosys was growing, Amazon was growing. Why? Because everybody saw the shift from work from office to work from home. As a result, people started to have 100% efficiency in their productivity levels. Got it? As a result, the tech companies also started to increase. Again, just like hedging, diversification is not about avoiding the losses completely, but it is all about reducing the impact of the loss. Are we clear?
Yes, sir.
Pragna, how if I will give you 10 lakh rupees right now?
Yes, sir.
Hypothetical situation. How will you diversify it?
So like equal amounts in all the different assets, sir. Like equity, bonds, mutual funds.
Okay,
Like 2 lakhs in.
I will say that you have invested in 5 different asset classes.
Yeah, sir.
Your first asset class you mentioned is equity.
Yeah, correct.
That where will you invest your 2 lakhs in equity?
So the
What
company which
sectors?
is like Reliance and Infosys.
Apart from that, sectors. Give me any 5 sectors that you will invest. 50,000 each.
Okay. So it will be like tech sectors.
Okay.
Okay. Other one would be like aviation.
Okay.
One FMCG sector.
Okay.
Then this one, I mean steel sector.
Okay.
Other one would be like
Banking sector.
yeah, banking sector.
This is diversification. And your
Okay.
third and the last shield that you have to protect you against the risk is insurance. Insurance is basically your safety net. What are you doing here in an insurance? The moment you buy insurance, you are paying small amounts in form of premiums that are regular. Yes or no? In return, what is the policy protecting you against? Uncertainty.
Mishappening.
In return, it is protecting you against uncertainties or any future disabilities that might arise due to an accident. So in finance also, in finance and businesses both, insurance takes many forms. You have health insurance, you have business insurance, you have credit insurance, and there are different types of insurance. Health insurance, it covers your hospital expenses. Business insurance, it will help recover the business when there are no operations in the business. So during COVID-19, businesses that had business insurance covered, they helped the companies recover when the lockdown was forced, when the operations were stopped. And then thirdly, you have something called as credit insurance. So it is an insurance that I as a broker will take to protect myself if the lender or if my borrower defaults in the future. I am the lender, you are the borrower. If you fail to repay that back, I have an insurance covered so that I am not losing out on my principal amount. So what is insurance doing? It is not preventing you against the risk. It is transferring your risk to another party. I am passing on the risk from my shoulders to the insurance company. Are we clear? Why am I doing this? Because I do not want to wipe out on the entire savings that I have. Are we clear? Are we clear on the insurance part?
Yes, sir.
Okay. Can you guys give me one example where you or probably anyone from your family has benefited from insurance, and what type of insurance was that?
Health insurance.
Health
Yes. How
insurance,
has
sir.
it benefited, Deepika?
Yes, sir.
How has health insurance benefited you or your family members?
So when I underwent a surgery, I had previously insurance. So when I underwent a surgery, they have given the amount, so I need not pay anything.
Any single penny.
Yes.
Right. Fair enough. Apart from health insurance or medical insurance, has any other type of insurance helped you guys?
Sir, motor insurance.
Yes,
Which
sir.
ins-
Vehicle insurance.
vehicle
सर
insurance?
हाँ सर, एक्चुअली मेरे कार पे बम्पर पे एक स्क्रैच आ गया था तो पापा ने पूरा रिप्लेस करा दिया क्योंकि इंश्योरेंस था उसमें।
That is
हाँ सर,
vehicle
मेरे
insurance.
तो स्कूटी ठोक दी थी।
Okay. Or any other types of insurance?
The building insurance, one of my friend owns a multiplex.
Mm-hmm.
It got burned down.
Mm-hmm.
So the insurance company covers all the expenses to renovate it again.
Okay. Has anybody taken fire insurance, theft insurance, mobile water damage insurance?
Yes,
Yes,
sir,
sir.
the
Theft
printer.
insurance.
हाँ तो बताओ ना, अब मेरे बोलने के बाद तुम लोग चिल्लाओगे तो? That is why I ask questions. Apart from medical, health, vehicle insurance, there are a lot of insurance. Theft में insurance है, gold पे insurance है, furniture पे insurance है. Have you guys
मोबाइल
ever
फोन
heard of these?
Yes,
Yes,
sir.
sir.
No?
Yes, sir.
Then why don't you open your mouths?
सर
Always to impress the interviewer, you have to take a route that nobody else takes.
सर पेट
Basically, you have to
इंश्योरेंस
impress, not express.
सर वॉइस इंश्योरेंस भी तो होता है सर, गले का।
हाँ.
वोकल इन्फ्यूज
There are many insurance. Like Ronaldo had the insurance of his legs of
लेग्स
300 crores.
हम्म
A model, hand model has an insurance of his hands around 150 crores.
Where are these
Pharma
ideas?
companies,
Where are these thoughts?
pharma companies has insurance of their equipments.
पेट इंश्योरेंस
Hi,
आल्सो
Nitesh.
ऐसे तो जो लोग मॉडलिंग करते हैं उनका तो बहुत जगह के इंश्योरेंस।
Okay, chalo. We've come to the end of the session. We have learned what is hedging. We have learned what is diversification, what is insurance. Now, it is time for you guys to put those learned concepts into action. You guys will be acting as portfolio managers. Imagine you are designing an investment policy statement. What are you designing?
Investment policy statement.
What three things should be covered in investment policy statement?
The goal, strategy, and the constraints.
All three things. Remember that. So you are supposed to build an IPS for a client. This client could be your HNI. It could be an individual client. It could be anybody. Okay. Your job is to identify 3 risks that your client is going to face. And then you will decide on how are you going to use your 3 tools. That is your hedging, diversification, and insurance in order to protect your client. Are we clear?
Yes, sir.
Remember, your goal is to show how the tools that you have are going to actually work in place. If you're able to do that, that means that yesterday's and today's session, whatever I've taught has paid off. I will give you exactly 5 minutes to think and come up. I will randomly ask people to turn on the cameras and start talking. Then by 5:30, I will have the session winded up.
सर
हाँ.
सर आपने जो कहा एक बार रिपीट कर देंगे क्योंकि मेरे यहाँ पे नेटवर्क थोड़ा अनस्टेबल है
Sorry?
सर मेरे यहाँ पे थोड़ा नेटवर्क अनस्टेबल है तो आपकी वॉइस ना मेरे पास क्रैक होके आई है तो इसलिए आप जो आपने कहा वो आप रिपीट कर पाएंगे
मेरे को कुछ सुनाई नहीं.
Sir, he wants to repeat what you have told right now.
Basically, read the instruction. Assume that you're a portfolio manager. Identify 3 major risks that your client might face, whatever your client is, whoever he is, and you are supposed to propose a strategy to mitigate the risk using hedging, diversification, and insurance.
Okay, sir.
बस उतना ही. See, there were 30 participants. Now it's already become 23. I do not want anybody to leave the class now. Start working on this next 5 minutes. By 5:22, I will ask people to call out names, basically. Allah.
भाई विकास फोन कर रहा हूँ उठा लेना
क्लास में हूँ अरे उड़ के थोड़ी आ जाऊंगा क्लास चालू है अभी
विकास माइक ऑन है
सॉरी
Yes, Shishan.
Yes, sir. I thought of one idea.
Yes.
So can I say that?
What idea is this related to?
Sir, about the risk management you told.
Okay.
If I like three major risks
Give me
that
2 more minutes. 2 more minutes.
Okay, okay, sir. Sorry.
I will start off with you.
Okay, sir.
Okay, guys. We done?
Yes, sir, Avik.
Yes.
Sir, am I visible?
You are visible.
Sir, basically, if I have to manage portfolio, then I would like to invest in the companies जो मतलब अभी buildings वगैरह बना रहे हैं, जैसे कि अभी ढोलेरा, जैसे आपको पता होगा अहमदाबाद में बहुत पॉश एरिया बनने वाला है, तो वहां पे मैं 1 to 2 एकड़ में जमीन खरीद के रख दूंगा। एंड देन अभी सिल्वर एंड गोल्ड का प्राइस बहुत ज्यादा अप होने वाला है, तो सिल्वर का प्राइस स्पेसिफिकली बहुत ज्यादा अप होगा, तो उसके ऊपर मैं इन्वेस्ट कर दूंगा। एंड देन आपके क्या बोलते हैं उसको, क्या बोला था मैंने, गवर्नमेंट बॉन्ड्स के अंदर जैसे आरबीआई का एंड माइक्रोसॉफ्ट में सर, क्योंकि सर अभी हम लोग एक्सेल वगैरह यूज करते हैं, तो उसके अंदर भी सर माइक्रोसॉफ्ट जो है को पायलट वगैरह इसके अंदर बहुत जा रहा है, तो उसके ऊपर भी हमको आगे जाके प्रॉफिट मिल सकता है। तो इसके लिए सर ये 4 जगह पे इन्वेस्ट करूंगा मैं। यस सर।
हो गया?
हाँ सर हो गया। सर एक और जगह है पर वहाँ पे मतलब बहुत ज्यादा पैसे लगेंगे पर सर हाईली रिटर्न होगा। जैसे सर साउथ भोपाल है, आपका गांधीनगर है, वहाँ पे अगर कोई बिल्डिंग बना रहे तो जनरली वहाँ पे जाके अगर हम लोग इन्वेस्ट करते तो वहाँ से भी हाई रिटर्न आएंगे हम लोग को। रियल एस्टेट कह सकते हैं सर।
Okay, सही है. Yes,
Right,
Ishan.
sir.
Others, I want you guys to switch on your cameras, please.
Yes, sir. Am I visible, sir?
Yes, hi.
Yeah. So when we design
Smart
an
gentlemen we have in the team, but nobody dares to turn on the camera.
No, pardon?
I was saying we have so many smart gentlemen and ladies, and yet we don't turn on the cameras. Yes, Vikas, Akshat, Anuj, Pragna, Krishna, Nitya, Prachi, Shayansh, Kasim, Kalami, Teja. All of you, quickly. We barely have 7-8 minutes. That's all.
सर विकास का आंसर रेडी है पर वो बोलना नहीं।
Vikas, where did you
Hello.
decide?
Yes, sir. Sir.
Okay. Anjali, Akshat, Anuj, where is Lucky?
Yes, sir.
Oh, I could see you.
Thank you. I can.
ऑफिस में बैठे हैं।
Yes, sir. So can I say now?
Yes, please.
Like when we design an investment policy statement, one of the most important part is managing risk. Like every investor, I feel faces 3 main risks, and we have and we have 3 powerful tools like we discussed them in our lecture right now. So the first is the market risk. Like when the whole market falls due to interest rate or global event, there we use hedging. So for that, we can buy a put option on one stock, and that will protect us if the price crash. Then the second is the company or the sector risk. Like where one industry or company performs badly, the best tool here is like diversification. So by spreading money across different sectors and um, geography, maybe the failure of one company does not wipe out the portfolio. Then the third is like the personal risk. So things like illness, accidents, even or like a few events like anything can happen. We don't know. Death is very uncertain. So this is where the insurance plays a role. For example, health insurance or life insurance that ensures personal shocks that don't destroy the financial stability. So hedging risk and diversification in the company risk and personal insurance, they make our investment policy statement like a strong one.
What was your client profile?
A normal person.
A normal person. Fair enough.
Yes, sir.
Is there Deepika?
Sir, I attended class at 5:15 today, but I can try.
Sorry, I didn't get you.
I attended class at 5:15 today. I couldn't attend at 2 o'clock, but I missed half of the class, but I can try.
You understood the part, right? Activity part.
Yeah.
Go ahead. Give it a try.
Okay. So if I have taken a startup, the startup is into a sari business. So sari business mainly main risk will be their stocks. So here now we get to know that the stocks has set up a fire or something like that. So I will have a fire insurance for that first thing. Second thing, in case some saris in case if they in future if they face any legal suit or something like that, due to which I will face a financial loss. In that, I will have a one more insurance for the product. So to insurance, that insurance part. Then coming to the risk, external risk I might not have, because cloth is a need, it is a basic need. So majorly I might not get affected, but internally if something happens to the management or something like that, then I might face a problem. So I will have a strong internal controls, internal check. I will have a stock audits, so that the sari is not stolen, or the pricing, whatever I've done correctly. So all these checks I will have.
Fair enough. Kasim,
Yes. Hello. Am I audible? Good afternoon, sir. So, starting on first. So, I have been tasked with preparing a risk management strategy for as an investment policy statement for a client. I've taken my client to be, let's say, a pension fund. Okay, and now I'll be outlining three risks that are sort of commonplace for pension funds. So first is the market risk, which we can take as volatility of stocks, which we can take as inflation, which which we can take, yeah, inflation and volatility of stocks. So what this market risk does is it erodes our profits. So our profits, since it is a pension fund, it would erode the predictable returns. How we can mitigate this market risk is that we can use hedging, as in we can use strategies such as swaps. We can do interest rate swaps, so that we have a predictable return. We can mitigate this risk by hedging. We can do futures and options. And yeah, talking about the second risk. So for the second risk, there is concentration risk. So let's say our pension fund is only investing in one specific class or one specific sector. There we will have concentration risk. So what we can do to mitigate this concentration risk is we can diversify a portfolio. So instead of investing in one specific instrument or in one specific sector, we can invest in multiple instruments. So we can invest in the real estate sector as well. We can, if we have a large enough portfolio, we can go international as well. We can invest in like US bonds as well. So it's diversified. And talking about the third risk, there will be uh, third risk was the unnatural risk, I guess, the unexpected risk. For example, there are natural.
third was your liquidity risk.
Yeah, so for example, if natural disasters happen or fraud happens, so how do you mitigate with that risk? So to mitigate with that risk, we usually do it through insurance. For example, if there's a factory we have invested in, and factory buys a fire insurance premium, so any if by chance the factory is set on fire, our risk will be mitigated through insurance. So, yeah. Thank you.
Fair enough. Lucky, would you take the opportunity?
Yes, sir. Sir, can I share the screen?
Yes, please go ahead.
Okay. So the question was, assume you are a portfolio manager for a client, HNI client or pension fund or startup. Identify three major risks for my client. Purpose, how to mitigate the risk which I was identified. And diversification, matlab, purpose for mitigation and strategy. So I prepared this. My client is HNI client. The risk tolerance is aggressive to moderate. Age आ गई. Age is 35, if I say. So his objective is to capital appraisal and passive income. He want to appreciate his capital and want to have a passive income. He want to. I am suggesting him to diversify in equity, fixed income, alternative incomes, real estate, and cash. Equity for like domestic, domestic में Reliance Industry, for example, and I want to diversify his portfolio to international also. Like I'm going to invest in Nvidia also. Fixed income में I will go for FDs and bonds, which will be secured, like government bonds and FDs. So I will be getting a fixed income no matter what, and I will be go for a alternative investment like ETF, REITs, real estate investment in market. Real estate में I will go for real estate for a area which was developing right now and we have a potential to grow along, as Avik mentioned, in Ahmedabad. I will go for it for long term, like for 20 to 30 years maybe, or long. I will have some cash in my pocket if any opportunity arrives, so I can catch it. Like if market falls, a company crashes, or a sudden news hit, or anything like that, or a great IPO was coming, so I can invest in. So the risk I am facing here are market risk. I can mitigate it by hedging in options, future, and I can diversify also. Sorry, the spellings are not correct.
चलेगा चलेगा.
Also, there are credit risk. Like I am in bonds. I am in bonds. So there can be a bonds of B rate, which can default. So I can get an insurance on that if anything
Mentioned you're
happens.
going to invest only in government bonds and FDs. Government bonds के लिए there is no B rating, I would say.
No, yes. Sorry, that I get.
So if you
Like if I lend money to someone, if I lend money to someone and he defaults, so I get a credit risk for that. So I can I can get an insurance for that. Diversify my bonds in SGBs, gold bonds, bank bonds, and corporate bonds. And I also have a liquidity risk, like if COVID-19, if pandemic like COVID-19 hits, so I am not able to sell my equity, real estate, alternative, and I am locked in my fixed income. So I am not able to have any cash at that point. So I may be in a liquidity risk, and I want a surgery, so I can have an insurance for that also. Like I can secure myself with a health insurance, so I may not face any situation in which I will be having a liquidity risk. Like in COVID-19 time, I cannot sell my equity, and no one is ready to take my real estate. And I am having a major surgery, so I can mitigate that risk by taking an insurance against my health.
Okay. Fair enough. Wonderfully put across.
Thank you.
Same goes to all Deepika, Kasim, Ishan, and Yar. Anybody else would want to go, or are we good to wind up this session?
Sir?
Yes.
Sir, with this activity today we did, it makes me understand that, like, with hedging and diversification and insurance, we can make the risk our servant and not our master.
Correct. You remember the Avengers famous dialogue?
Yes, sir.
What is it?
Avengers movie, no? Sir, they fight the risk. They do not
With
stop
great
the risk.
power,
With great power come great responsibility.
responsibilities.
So
Right?
it's a Spider-Man dialogue.
It's part of Avengers as well. Cool. Anybody else wants to go, or are we good to wind up the session?
Sir, may I?
Yes, please.
Sir, Akshar.
Yeah. I can see you.
Yeah. So, sir, I am visible?
Sorry?
I am visible to you?
Yeah, you are visible, you are audible.
So, sir, basically, my client was HNI, high net individual. So, he's my client who was looking for some capital appreciation, that is long-term returns is looking for. But there are the three risks he's facing. First risk is the market volatility, that is a systematic risk, which are not the diversifiable. It is due to the economic downturns or macroeconomic factors. So, sir, they are not, as they are non-diversifiable, we use the strategy here, mitigation strategy, that is hedging, basically which will help him to allot a portion portfolio to derivative instruments like put options, future contracts. So basically, they are just like insurance policies. This strategy acts so that if the market declines, these derivatives will increase. This helps in offsetting some of the losses. So these are the basic mitigation strategy in terms of the market volatility we are facing. Second is the client is basically the concentration risk. That is when the portfolio is heavily invested in the single stock sector or asset class. So we can use the mitigation strategy, that is the diversification. We can build the portfolios across the equities, fixed income instruments, alternative assets. So the concentration can be mitigated by the diversification tool. And the third risk that he can face is the catastrophic event, that is due to the natural disasters, forceful situations. His physical assets go into the losses. So we can use the tools such as insurance, like we can use the business insurance, property insurance, life insurance. We can use to mitigate the risks. Basically, these are the mitigation tools which can be used in different types of risk.
Fair enough. A bit lengthy. Yeah, good one. Okay, cool. I hope the test is going as planned.
So the module 1 test
Yes, module 1.
that I have already given.
You've already completed. Okay. Right. Others, try completing it as early as possible so that the valuation is done and then you have feedback on that given so that you are prepared for the next test. Okay?
Sir,
Yes. Any
Sir,
doubt?
sir, not a doubt, but sir, how can I improve my English?
How can you improve your English? Read newspaper.
सर न्यूज़पेपर तो सर 1 साल से रीड कर रहा हूँ, हो नहीं रहा.
जोर से.
Please refer English में.
Read newspaper in front of the mirror.
Okay.
Sir.
Yes.
Sir, basically, I want to ask that, sir, sir, just like the module 1 test, there will be module 2 test and the final examination.
Yes.
Sir, you have not
Then
shared the syllabus part.
After today's session, today's recording के साथ I'll upload the syllabus copy.
So, sir, after the final exam, we are divided into the sections that on the basis of which we will
After
get.
module 2, you are divided into 2 pathways.
Sir, could you explain a bit more on what the basis of the division would be and what the two parties would be?
You weren't there yesterday.
Sir, I think I missed this part yesterday.
Okay. So basically, the division would be majorly on your choice and your performance during your module 2 and your Viva. So if you have extensive financial knowledge, probably you will moving on into the mid-office domain, the research division. If you have not that extensive knowledge on finance, probably you would be working for the operations one. That is the pathway one. Any other questions?
So, sir, does this roles will mention on a certificate subject to course completion?
No, I don't think so.
Okay.
Okay then. Cool.
Sir, please upload the PPT after that.
Yes.
Sir, if you were there with the same question, how will you answer it?
Which question?
The same question. Assume you are a portfolio manager for a client.
The same question for me. I was not prepared for that. I thought taking answers from you would be better.
No, sir, we have given already the answer. Like, I think only 10 participants are left. Everyone has given their best.
Yes.
So we can
So
hear
if I
from you.
were a portfolio manager, if my client is, let's say, HNI, so the three major risks that I will identify is that, of course, not with the liquidity part. I will be well versed with market risk, I would say. Then the operational risk. These two are major risks for HNI clients. So in order to mitigate that risk, obviously for HNI clients, I will have diversification strategy. So when I say diversification, I will not only concentrate on the home funds or the investments that are related to just one country specific. I would diversify his investment or her investment across the globe so that I have better returns and quicker returns with minimal risk. And secondly, when I have to talk about mitigating the risk in terms of, let's say, his hedging strategy, right? If he's an HNI client having his investments in foreign countries, it is likely that I might be at time of booking the profits, I might incur a loss in terms of the difference amount between the countries' currencies. So in order to overcome that, I would probably enter into a contract, that is a future and an option contract, to mitigate that particular risk. And in terms of insurance, and that particular person having that much wealth would obviously need insurance in terms of protecting his wealth, right? In terms of protecting his child's future, right? And for that purpose, I would obviously look for insurance opportunities, not just specific to health, but specific to his business, specific to his kids. I would rather focus more on life insurance rather than health insurance. So this would be my strategy.
Sir, for HNI client, what will be the operational risk like?
For HNI clients, the operational risk, first and foremost, is that, see, now the moment we invest huge money from of an HNI client into, let's say, for example, in the stock markets, right? There might be chances that I might incur into a mistake or I might make a mistake. Instead of having a entry price point at, let's say, 545, due to some technical issue, my team members have entered at 548, which was not my pre-decided price. So that would act as an operational risk to him, right? Even a 3 rupee change in the minimal amount of investment, right, is going to impact his portfolio heavily. It is an error from my end, right? So having it covered by diversifying it will give me an added advantage. Am I clear?
Yes, sir.
Any more questions?
No, sir.
Okay. Cool, guys. Thank you so much. Have a good evening. See you next week.
Thank you, sir. You too.